Hello there, and welcome. I'm so glad you found your way here tonight. Before we begin, take a moment to get comfortable. Adjust your pillow, let your body settle into whatever position feels right. There's no rush. We have all the time in the world. Tonight, we're going to explore a peculiar moment in history. A time in the late 1990s when a company that delivered pet food to your door could be worth more than entire airlines. When a website that let you order pizza online was valued at hundreds of millions of dollars, when simply adding .com to any business name could make you a millionaire. We'll discover how this happened, meet the people who believe the future had arrived, and gently unpack one of the strangest financial bubbles in modern history. But don't worry, this isn't going to be a frantic recounting of financial chaos or a judgmental exploration of human folly. Instead, we'll move slowly and carefully through the late 1990s, through the bubble itself, and through what came after. We'll take our time with the numbers, the stories, the genuine innovations and the absurd excesses. By the end, I think you'll find that the dot-com bubble was about more than money. It was about hope, imagination, and the very human tendency to believe that this time, everything really has changed. If you enjoy these calm explorations of history's most fascinating moments, a like and subscribe really helps reach others seeking the same peaceful way to end their day. And to those already subscribed, thank you for being part of this community of thoughtful listeners, so settle in. Let your shoulders drop away from your ears. Take a slow breath, in through your nose, out through your mouth, and let's begin our drift through the 1990s, through the bubble, through the crash, and toward understanding. There's nowhere you need to be, no deadlines to meet. Just listen and let the story unfold like a long, quiet conversation between old friends. Let it wash over you. If you drift away, that's perfectly fine. That's what we're here for. Let's begin in 1989, when the world was connected very differently than it is now. Think back, if you can, to a time before the internet was part of daily life. For those who remember it, there's something almost dreamlike about that world now. For those who don't remember it, try to imagine a world where, if you wanted to buy something, you got in your car and drove to a store. Where if you wanted to know something, you looked it up in an encyclopedia or called the library. Where if you wanted to talk to someone far away, you picked up a telephone attached to a wall by a cord and you paid by the minute for the privilege. This wasn't ancient history. This was the late 1980s and early 1990s. Personal computers existed. They'd been around since the early 1980s. But they were isolated machines, disconnected from each other, used mostly for word processing and spreadsheets. If you wanted to share a document with someone, you saved it onto a floppy disk, put that disk in an envelope and mailed it. Or you printed it and sent paper. These were the options. Some people had modems, devices that let computers talk to each other over phone lines, but the connections were slow and the uses were limited. You might dial into a bulletin board system, a BBS, where you could leave messages for other users or download simple files. But you couldn't download much. A single photograph might take 20 minutes. A song could take hours. Video was essentially impossible. There were some early online services. CompuServe started in the late 1970s, offered email and forums and some information databases. America Online, AOL, launched in 1985 and grew through the late 80s and early 90s, sending millions of CDR-OMS through the mail offering free trial hours. Prodigy, a joint venture between Sears and IBM, tried to bring online services to mainstream America. These services were closed systems, walled gardens. If you were on CompuServe, you could talk to other CompuServe users, but not to people on AOL or Prodigy. Each service had its own content, its own rules, its own little universe. But something was brewing, something that would change everything, though hardly anyone knew it yet. In 1989, a British computer scientist named Tim Berners-Lee was working at CERN, the European Particle Physics Laboratory in Switzerland. He was frustrated by how difficult it was to share information between different computers and different research groups. Scientists had information on various machines in various formats, and there was no easy way to link it all together. No simple way to navigate from one piece of information to another, so Berners-Lee invented something. He called it the World Wide Web. It wasn't the internet itself. The internet, the underlying network of networks connecting computers worldwide, had existed since the 1960s, built originally for military and academic purposes. But the internet was difficult to use, requiring technical knowledge and text-based commands. What Berners-Lee created was a way to make the internet usable by normal people. He invented a system where documents could contain links to other documents, where you could click on a word and be transported instantly to related information somewhere else, anywhere in the world. He created a language for formatting these linked documents, HTML, Hypertext Markup Language. He created a system for addressing them, URLs, those web addresses that start with HTTP. And he created the first web browser, a program for viewing these linked documents. He did all of this and, remarkably beautifully, he gave it away. He didn't patent it, didn't try to own it. He released it to the world, free for anyone to use. This was 1991, and the World Wide Web was born, though almost no one noticed yet. For a couple of years, the web remained the domain of academics and computer enthusiasts. There weren't many websites, and the ones that existed were simple text-based pages, mostly at universities and research institutions. If you wanted to use the web, you needed to know how to use Unix commands and understand technical documentation. It was powerful if you knew how to use it, but it was not ready for ordinary people, not yet. Then, in 1993, something changed. A group of students and staff at the National Center for Supercomputing Applications at the University of Illinois created a new web browser called Mosaic. What made Mosaic special was that it was easy to use and, crucially, it could display images within web pages, not just text. This sounds like a small thing, but it was revolutionary. Suddenly, the web could be visual, could be beautiful, could be more than just a library of text documents. Mark Andreessen, a young student who had worked on Mosaic, graduated and moved to California. There he met Jim Clark, a successful entrepreneur who had founded Silicon Graphics. Together they founded a company to build a commercial web browser that would be even better than Mosaic. They called it Netscape, and their browser was called Netscape Navigator. It launched in December 1994, and it was free to download. Within months, millions of people were using it, and here's where things started to get interesting, where the seeds of our bubble story were planted, though no one knew it yet. Let me paint you a picture of what it felt like to get online in 1994 or 1995, because that feeling, that sense of wonder and possibility, is crucial to understanding what came after. Imagine you're sitting at home. You've just bought a computer, maybe spent $2,000 on it, a significant investment. You've signed up for an internet service provider, probably AOL, maybe a local provider. You sit down at your desk, turn on your computer, and start the process of connecting to the internet. You double-click the connection icon. You wait. Your modem starts making sounds, a series of beeps and squeals and static, a digital handshake between your computer and the phone line. It sounds like a robot having a conversation with another robot in some alien language. You wait. 30 seconds. 45 seconds. Then, if you're lucky, you're connected. You're online. You open Netscape Navigator. The browser loads, and there in the corner is a little animated logo, the Netscape N with meteors flying past it. You type in a web address, maybe yahoo.com, one of the early websites that tried to organize the growing web into a directory of links. You press enter and wait. The page loads slowly, line by line, image by image, revealing itself over 20 or 30 seconds. And when it finally loads completely, you see it, a page of links, organized by category: news, sports, entertainment, business. Each word is underlined, highlighted in blue. You realize that you can click on any of these words and be taken to another page, another site, maybe on a computer on the other side of the world, that you can browse through information, jumping from topic to topic, following your curiosity wherever it leads. That you can do this from your home, at midnight if you want, without going to a library, without making a phone call. The information is just there, waiting for you, an endless buffet of knowledge. This was magical. It really was. For people experiencing it for the first time, it felt like the future had arrived. Like the world had suddenly opened up in a way it never had before. People stayed up late into the night, exploring, discovering, marveling. They sent emails to friends across the country and got replies within minutes instead of days. They looked up information about obscure topics and found it instantly. They discovered communities of people who shared their interests, no matter how niche. A person interested in collecting antique typewriters could find other collectors. Someone learning to play the guitar could find lessons and tablature. The world was suddenly smaller and simultaneously much, much larger. And it wasn't just individuals getting excited. Businesses started noticing too. Because if millions of people were getting online, spending hours browsing websites, well, that meant something, didn't it? That was an audience. That was potential customers. That was maybe the future of commerce. Some forward-thinking entrepreneur started wondering, what if you could sell things online? What if people could shop from their homes, browse through catalogues on their screens, click a button, and have products delivered to their doors? It seemed almost science fiction, but technically it was possible. The pieces were there. The web existed. People were getting online. Credit card transactions could be secured with encryption. The infrastructure was coming together. In July 1995, a small online bookstore called Amazon went live. It was started by a man named Jeff Bezos, who had been working at a hedge fund in New York when he read a statistic that caught his attention. Web usage was growing at 2,300% per year. 2,300%. He thought about what kind of products would sell well online, and he chose books. Books were perfect. They were easy to ship, they didn't spoil, there were millions of titles, far more than any physical bookstore could stock. He left his job, drove across the country to Seattle, and started Amazon in his garage. The first book was sold in July 1995. The business model was straightforward: offer a huge selection, competitive prices, and deliver books to people's doors. It was a real business, solving a real problem, creating real value. That same year, September 1995, a site called Auction Web launched, soon to be renamed eBay. It was started by Pierre Omidyar as a hobby project, a place where people could auction off items online. The first item sold was a broken laser pointer, which sold for $14.83. When Omidyar contacted the buyer to make sure they understood the laser pointer was broken, the buyer said yes, they collected broken laser pointers. Omidyar realized he might be onto something. There was a market for everything, no matter how obscure, and the internet could connect buyers and sellers who would never have found each other otherwise. But the moment that changed everything, the moment that lit the fuse on our bubble story, happened in August 1995. Netscape, the company that made the web browser, decided to go public. They held an initial public offering, an IPO, selling shares of the company on the stock market for the first time. Let me explain how this normally worked, because what happened with Netscape was decidedly not normal, and understanding the difference is important. When a private company goes public, it's selling ownership shares to anyone who wants to buy them. Investment bankers help set an initial price based on the company's finances, its growth prospects, what they think investors will pay. Then on the first day of trading, the stock starts at that price, and market forces take over. The price might go up a little or down a little, but usually for an established company, the first day is relatively calm. A 5 or 10% move would be normal. 20% would be a big day. Netscape's IPO was supposed to price at $14 per share. The company was only 16 months old. It had revenues of $16.6 million for the first half of 1995, but it was losing money. It had spent more than it earned. By traditional measures, this was not a company ready to go public. But the investment bankers saw the demand, saw how excited investors were about anything related to the internet, and they revised the price. The IPO priced at $28 per share, double the original plan, and then the stock started trading. By the end of the first day, Netscape stock closed at $58.25 per share, more than double the opening price. At one point during the day, it had hit $74.75. The company was suddenly valued at over $2 billion. Remember, this was a company that was 16 months old and losing money. But on that day in August 1995, none of that mattered. What mattered was that Netscape was the internet, and the internet was the future, and the future was apparently worth whatever people were willing to pay for it. Mark Andreessen, the young programmer who had helped create Mosaic and had co-founded Netscape, was 24 years old. By the end of that first day of trading, he was worth $58 million on paper. He appeared on the cover of Time magazine barefoot, sitting on a throne, the golden boy of the internet age. The image captured something essential about that moment. The youth, the casual confidence, the sense that old rules didn't apply anymore, that a kid could become fabulously wealthy in months by building something new and digital. The Netscape IPO changed the game. It showed that there was enormous appetite for internet stocks, that investors would pay premium prices for companies that represented the online future. That you didn't need profits, or even a clear path to profits. You just needed to be part of this new world that was emerging. And with that realization, the gold rush began. Entrepreneurs started thinking about what else could be moved online, what other businesses could be built. Investors started looking for the next Netscape, the next company that could turn them into overnight millionaires. Venture capitalists, the firms that provided early funding to startups, began throwing money at anything with a credible internet angle. The world before the web had been slower, more local, more limited. But now, in late 1995, the web was here, growing exponentially, and it felt like everything was about to change. People were getting online by the millions. Businesses were figuring out what this meant. Money was starting to flow toward anything digital, anything with .com in its name. And everyone, entrepreneurs, investors, engineers, ordinary people, everyone felt they were witnessing something historic, being part of a transformation as significant as the Industrial Revolution or the invention of electricity. They were right about that, as it turned out. The internet would change everything. But the path from here to there, from late 1995 to a world where the internet was woven into every aspect of life, that path was going to be much stranger, much more chaotic, and much more expensive than anyone imagined. Fortunes would be made and lost. Reasonable people would believe unreasonable things. The rules of economics would seem for a while to have been suspended. And millions of people would learn some very expensive lessons about speculation, about bubbles, about the difference between a genuine revolution and a financial mania. But all of that is still to come. For now, in late 1995, the web is young and full of promise. The bubble is just beginning to inflate, though almost no one would have called it a bubble yet. It just felt like the future arriving right on schedule, like progress unfolding exactly as it should. Let that image rest in your mind for a moment, the optimism, the genuine innovation, the sense of unlimited possibility. Because that feeling, that hopeful energy, is where our story truly begins. The Netscape IPO in August 1995 was like a starting gun, and suddenly everyone wanted to run the race. If Netscape could go from nothing to a $2 billion valuation in 16 months, well, what else was possible? What other internet businesses could be created? What other fortunes could be made? The questions hung in the air like possibilities waiting to be grasped, and people across America, but especially in Silicon Valley, began reaching for them. Let's think about what was happening psychologically, because it's important to understand how reasonable people came to believe some fairly unreasonable things. The internet was clearly transformational. That part wasn't hype, it was reality. Every month, hundreds of thousands of new people were getting online. Websites that hadn't existed a year ago were suddenly getting millions of visitors. Email was replacing fax machines and letters. The change was visible, tangible, happening right before everyone's eyes. So if the fundamental transformation was real, then it made sense that businesses built around it would be valuable, didn't it? The logic seemed sound, at least on the surface. The problems would emerge in how that logic was applied, in the leap from "this is transformational" to "therefore any company with .com in its name will succeed." But we're not there yet. In late 1995 and early 1996, the enthusiasm still seemed justified, still seemed like rational optimism about real change. Amazon, which had launched in July 1995, was growing remarkably fast. By the end of its first month, it had shipped books to people in all 50 states and 45 countries. Jeff Bezos had correctly identified something important. The web could offer selection that no physical store could match. A big bookstore might have 100,000 titles. Amazon could offer millions because they didn't need to stock everything. They could order from distributors and publishers as needed, and people loved it. The convenience of browsing from home, the ability to search for specific titles, the reviews from other readers, it created value that justified the business model. This was a real company solving real problems for real customers. They were losing money, yes, because they were investing in growth, building warehouses and systems and brand awareness. But there was a path to profitability that made sense, at least in theory. Buy books wholesale, sell them retail, take a margin. Simple. Traditional. The internet was just the distribution channel. eBay, similarly, had found something genuine. Piero Midia's simple auction site was growing organically, mostly through word of mouth. People discovered they could sell things they didn't need and buy things they did need, all without leaving their houses. Collectibles, antiques, used items. eBay was creating a marketplace that connected buyers and sellers more efficiently than classified ads or garage sales ever could. And eBay had a beautiful business model. They didn't have to own inventory, didn't have to ship products, didn't have to handle returns. They just took a small percentage of each transaction for facilitating the connection. Low overhead, high scalability. It made sense. But alongside these companies that had real business models, something else was emerging. Companies that were built more on hope than on logic. The thinking went like this. The internet is growing exponentially. Millions of people are getting online, and wherever there are millions of people, there's money to be made. Therefore, if you can get millions of people to visit your website, you'll figure out how to make money from them eventually. Get the eyeballs first, monetize them later. This became the mantra, repeated so often that it started to sound reasonable, even though it was, at its core, putting the cart before the horse. The domain name Gold Rush was one of the first signs of the fever that was building. Domain names, those website addresses like Amazon.com or eBay.com, were given out on a first-come, first-served basis by a company called Network Solutions. They cost $100 for 2 years, which meant that for $100 you could own business.com or investing.com or any other combination of words and .com that hadn't been taken yet. Some clever people realized this early and started registering domains they thought might be valuable someday, either to start businesses or to sell to others who wanted them. The prices for premium domains started climbing. Business.com, which someone had registered for $100, was sold in 1997 for $150,000. That single domain, just the name, just the right to use those letters in that order before .com, was worth more than many people's houses. Other desirable domains followed. Investing.com, loans.com, insurance.com, generic terms that businesses might want were suddenly worth tens or hundreds of thousands of dollars. The message this sent was intoxicating. even something as simple as a name, if it was the right name with .com after it, could be worth a fortune. The internet wasn't just valuable, it seemed, it was transforming everything it touched into gold. Venture capital firms, the partnerships that invested in early-stage companies, began pouring money into internet startups. Before the Netscape IPO, venture capital had been a relatively conservative business. Firms would carefully evaluate business plans, demand evidence of market demand, require detailed financial projections. The goal was to find companies that could grow steadily over 5 or 10 years and eventually either be acquired or go public. But suddenly, the timeline compressed. Companies were going from founding to IPO in 2 years or less. The returns were extraordinary. If you had invested early in Netscape, you could have made 10 times or 20 times your money in just a couple of years. That kind of return was impossible to ignore, so venture capital money started flowing more freely. If you had a credible idea for an internet business, a decent team, and some technical capability, you could probably raise a few $1,000,000, maybe more. The firms that funded you would take a large ownership stake, perhaps 20 or 30 or 40% of your company, but they'd give you the money you needed to hire engineers, rent office space, buy servers, start building. The implicit deal was grow fast, get big, dominate your market segment before competitors do, and worry about profits later. This wasn't completely crazy. There were network effects in many internet businesses, meaning the first company to achieve scale had real advantages. If everyone used the same auction site, that site became more valuable because it had more buyers and more sellers, which attracted even more of each. Being first and biggest mattered in a way it might not in traditional industries. But here's where the thinking started to get fuzzy, where logic began to slip into speculation. Because not every internet business had real network effects, and even for those that did, being first didn't guarantee lasting success. You had to be first, and good, and well executed. But in the excitement of the moment, these nuances got lost. The story became simpler. Internet equals good. .com equals valuable. Funding equals necessary. Growth equals success. Each of these equations had some truth to it, but strung together they created a narrative that was more fiction than fact. The media amplified everything. Magazines started running cover stories about the internet and the fortunes being made. Wired magazine, which had launched in 1993, became required reading for anyone who wanted to understand the digital future. Businessweek, Forbes, Fortune, the mainstream business press started covering internet companies breathlessly. Television news did segments on this new way of doing business. CNN had technology reporters. CNBC, the financial news channel, started covering tech stocks more prominently. And everywhere the message was the same. This is big. This is important. This is the future, and it's happening now. Ordinary people started paying attention. Your neighbour mentioned he'd bought some shares in an internet company, and they doubled in 6 months. Your cousin forwarded you an article about 25-year-old millionaires in Silicon Valley. Your dentist asked if you'd heard about this Amazon place where you could buy books online. The internet was seeping into everyday conversation, and with it came stories about money being made, opportunities being seized, futures being built. It created a fear of missing out, a sense that history was happening and you needed to be part of it or you'd be left behind. Some people started investing in internet stocks directly, opening brokerage accounts, often at online brokers like E-Trade or Ameritrade, which were themselves beneficiaries of the internet boom and buying shares in public internet companies. Others invested indirectly, through mutual funds that focused on technology or growth stocks. The amounts were usually modest at first, a few $1,000s maybe, an amount you could afford to lose, though you didn't think you would lose it because everything was going up. The stocks were volatile, yes, they'd swing up and down by 10 or 15% in a day sometimes, but the overall trajectory was upward, and that's what people focused on. They'd check their accounts and see their investments up 20%, 30%, 50%. It felt good. It felt like winning. It felt like being smart enough to see the future before others did. The venture capitalists and entrepreneurs had their own version of this feeling. If you were a VC who had passed on funding an early internet company, and that company was now worth hundreds of millions, you felt the sting of the opportunity missed. You didn't want to miss the next one. So you became more willing to take risks, more willing to fund companies at earlier stages with less proof of concept. And if you were an entrepreneur, you saw people with similar backgrounds and similar skills raising millions of dollars for ideas that didn't seem better than yours. You thought, I could do that. I should do that. Why not me? This was both inspiring and dangerous. Inspiring because it democratized entrepreneurship, made it seem accessible to anyone with a good idea and some technical ability. Dangerous because it removed some of the healthy skepticism that normally acts as a brake on bad ideas. By 1996 and into 1997, the pace was accelerating. More companies were being founded, more money was being raised, more IPOs were happening. Yahoo, which had started as a directory of websites created by 2 Stanford graduate students, went public in April 1996. The stock nearly tripled on the first day. Lycos, an early search engine, went public the same month with similar results. Excite, another search engine, had gone public a few months earlier. These were companies built around helping people navigate the growing web, and there was logic to their value. If millions of people used your site to find other sites, you had something valuable. You could sell advertising or license your technology, or partner with other companies. The path to profit wasn't entirely clear yet, but it was plausible. But other companies going public or raising money were more questionable. Companies that wanted to sell groceries online, or flowers, or pet supplies, or office supplies, or toys. The theory was that anything that could be sold in a store could be sold online, and that online would be better because of selection and convenience. And maybe that was true, but it didn't mean that every company trying to do it would succeed, or that the market could support dozens of competitors in each category. These details were often ignored in the rush to fund and build and grow. Take the example of online grocery delivery. Several companies were founded in the mid-90s with the idea that people didn't want to go to grocery stores, that they'd rather order online and have food delivered. Peapod started in 1989, before the web, as a dial-up service, and then transitioned to the web. Webvan would launch in 1996 with enormous ambition. Home Grocer started around the same time. The vision made sense in theory. Grocery shopping is a chore. People hate it. Save them time and they'll pay for the convenience. But the economics were brutal. Groceries have very low margins. Stores make only a few % profit on most items. Add in the cost of warehouses, delivery vehicles, drivers, the logistics of keeping fresh food fresh, and it wasn't clear how you could make money. But that wasn't stopping anyone from trying, because the market seemed infinite, and the rewards for winning seemed enormous. The phrase first mover advantage was used constantly. It came from business strategy theory, and suggested that the first company to dominate a market could lock in customers and lock out competitors. In some markets, this was true, but it became an article of faith that applied to everything, a justification for moving fast and spending heavily to grab market share. Build brand awareness, acquire customers, become the name that people think of first when they think of your category. Worry about profit margins later, after you've won. This was the logic, and it was repeated so often that it became conventional wisdom. Alongside first mover advantage came quote 4, which we touched on earlier. The idea was that some products or services become more valuable as more people use them. Telephones have network effects. A phone is useless if you're the only person with one, but becomes more valuable as more people have phones you can call. Social networks have strong network effects. You join Facebook because your friends are on Facebook. Some internet businesses genuinely had network effects. eBay did. More buyers attracted more sellers and vice versa. But many internet companies claimed network effects that didn't really exist. An online pet food store didn't become much better just because lots of people used it. The food was the same. The prices were the same. There was convenience, yes, but not the kind of lock-in advantage that true network effects create. But these concepts, first-mover advantage and network effects, exponential growth, they were powerful ideas that justified the spending and the valuations. They made it seem like the normal rules of business didn't apply, or at least applied differently to internet companies. Traditional businesses had to make profits to survive. Internet businesses could burn through cash for years as long as they were growing, as long as they were building toward eventual dominance. The logic was, lose money now to make huge profits later. Amazon was doing this successfully, growing revenue dramatically while losing money on operations. If Amazon could do it, why couldn't others? What wasn't being asked, or wasn't being asked loudly enough, was, what if there isn't room for 20 companies doing the same thing? What if customers don't actually want to buy everything online? What if the delivery costs never come down enough to make the economics work? What if building a brand is more expensive than you thought? What if? What if? What if? These questions were inconvenient. They suggested limits, and this was not a time for thinking about limits. This was a time for vision, for boldness, for betting big on the future. The skeptics were dismissed as people who didn't get it, who didn't understand how transformational this was, who were stuck in old economy thinking. And to be fair, some skepticism really was misplaced. There were people who said the internet was a fad, that it would never be more than a niche hobby for computer enthusiasts. There were people who said no one would ever feel comfortable typing credit card numbers into a website. There were people who said traditional retail would always dominate because people wanted to see and touch products before buying them. All of these skeptical predictions turned out to be wrong. The internet was not a fad. People did become comfortable with online transactions. And while physical retail didn't disappear, online shopping became massive, eventually capturing a significant percentage of total retail sales. So the optimists were right about the big picture, which made them confident they were right about everything else too. This was their mistake, assuming that being right about the transformational potential of the internet meant being right about every individual company and every business model. By late 1997, the pieces were all in place for what would come next. There was massive public interest in the internet. There was abundant venture capital funding. There was a steady stream of successful IPOs showing that going public could make founders and investors incredibly wealthy. There was media coverage that portrayed internet entrepreneurship as exciting and glamorous. There were genuine success stories like Amazon and eBay proving that real businesses could be built online. And there was a growing belief that the old rules didn't apply, that we were in a new era where growth mattered more than profits, and where anything with .com in its name had value simply by virtue of being part of this transformation. The stage was set. In the years ahead, the enthusiasm would grow into something wilder, stranger, harder to justify. The amounts of money would become larger. The business models would become more questionable. The valuations would become divorced from any rational assessment of value. But all of that was still coming. For now, in late 1997, the gold rush was gathering momentum but hadn't yet become pure mania. People were excited, optimistic, energized by possibility. They were making money, or at least their portfolios said they were making money. The future seemed bright and unlimited. The bubble was inflating steadily, but still slowly enough that most people didn't see it as a bubble at all. It just looked like progress, like the natural evolution of business and technology, like the future arriving exactly when and how it should. Let that feeling settle for a moment. The hope, the excitement, the sense that you were witnessing and participating in something historic. Because that feeling, however it would later be re-examined and reinterpreted, was real for the people experiencing it. They believed, and belief for a time was enough. As we move into 1998 and 1999, something shifted. The enthusiasm that had seemed rational, or at least understandable, began transforming into something harder to justify. The logic that had connected the dots between the internet is transformational and therefore internet companies are valuable started to break down, or rather, started to stretch so thin that it barely held together at all. But the remarkable thing was that most people didn't notice the logic breaking down, or if they did notice, they didn't care. The momentum had become self-sustaining. The bubble had developed its own gravity. Let's talk about how value was being measured, because this is where things became particularly strange. In traditional business, a company's worth is based on some combination of its current profits, its expected future profits, its assets, and its market position. You look at how much money a company makes. You think about whether it will make more or less in the future. You consider what it owns, and you arrive at a valuation. Different people might disagree about the details, but the framework was understood and had been tested over decades of market history. But internet companies in the late 90s were valued differently. Most of them had no profits. Many had no revenue at all. They were giving away their services for free, hoping to build an audience first and figure out how to make money from that audience later. So the traditional framework didn't work. You couldn't value these companies based on profits they didn't have. Instead, analysts and investors started using different metrics that made sense at first, but that became increasingly divorced from reality as the bubble inflated. The most important metric was eyeballs. How many people visited your website? How many unique visitors per month? How many page views? These numbers became the primary way of assessing an internet company's worth. The logic went like this. If millions of people use your site, you have something valuable, because eventually you'll figure out how to monetize those users. You'll sell them things, or sell advertising to people who want to reach them, or license your technology or something. The specifics didn't matter as much as the audience size. Get the eyeballs first, the thinking went. Revenue will follow. This wasn't completely insane. Television networks and radio stations had been valued based on audience for decades. Advertisers paid to reach eyeballs and ears, and the bigger the audience, the more they paid. So there was precedent for this way of thinking. But television and radio had mature advertising markets with established rates and proven models. Online advertising was new, unproven, and as it turned out, much less valuable than anyone expected. The economics of online advertising were broken from the beginning, though it took a while for people to realize this. Websites would sell banner ads, those rectangular advertisements that appeared at the top or sides of web pages. The standard deal was that advertisers paid based on impressions, meaning each time the ad was displayed. The rates were measured in CPM, cost per 1,000 impressions. In the early days, CPMs might be $20 or $30 or even $50, meaning an advertiser paid that much for 1,000 people to see their ad. This seemed reasonable compared to print advertising in magazines or newspapers, but there were problems. First, people quickly learned to ignore banner ads. Your eyes would naturally skip over them as you browsed a page. The click-through rate, the percentage of people who actually clicked on an ad, was initially around 2%, which seemed okay, but it quickly dropped to 1%, then 0.5%, then 0.1%. People didn't just ignore the ads, they became actively annoyed by them. And even when someone did click on an ad, they often didn't buy anything. So the value of those impressions, of those eyeballs, was much less than anticipated. Second, there was infinite inventory. A magazine has a limited number of ad pages. A television network has a limited number of commercial minutes. But websites could add pages infinitely. Every new page was potential ad space. This meant that supply vastly exceeded demand, which drove prices down. CPM rates began falling from those initial high levels, heading towards single digits, then toward pennies. The economics that looked promising in 1996 or 1997 looked terrible by 1999. But by then there were hundreds of companies whose entire business model depended on advertising revenue that wasn't materializing. But let's set aside advertising for a moment and talk about some specific companies, because the particular stories help us understand the general madness. Let's talk about Pets.com, which became perhaps the most famous symbol of .com excess, largely because of a sock puppet dog that appeared in their advertisements. Pets.com launched in November 1998 with a simple premise. People would rather buy pet food and supplies online than go to a pet store or grocery store. The company raised money from venture capitalists, including Amazon, which invested and owned a stake. They built a warehouse, created a website, and began selling pet supplies. The prices were competitive, often lower than retail stores. Shipping was free on orders over a certain amount. The service was convenient. Everything seemed to make sense, except the economics didn't work. Pet food is heavy. Bags of dog food weigh 20 or 30 or 40 pounds. Shipping heavy items is expensive. Cat litter is even worse. A 20-pound bag of litter that sells for $5 or $6 costs several dollars to ship. Pets.com was selling items for less than they paid for them, then paying to ship those items to customers, losing money on every transaction. The theory was that they'd make it up in volume, which is a joke that business students tell each other because it's so obviously impossible. You cannot lose money on every sale and make it up in volume. The math doesn't work, but Pets.com and their investors believed that once they achieved scale, once they were large enough, the economics would improve. Suppliers would give them better prices, shipping costs would come down, customers would order regularly, becoming more profitable over time. Something would change. It had to, didn't it? To build brand awareness and customer base quickly, Pets.com spent enormous amounts on advertising. They bought a Super Bowl ad in January 2000, one of the most expensive advertising purchases possible. The ad featured their sock puppet mascot, which became more famous than the company. The sock puppet appeared on talk shows, at sporting events, in parades. It was charming and memorable. But charm doesn't fix broken unit economics. By the end, Pets.com had burned through more than $300 million in 9 months and shut down in November 2000, less than 2 years after launching. The investors lost everything. The employees lost their jobs, and the sock puppet became a symbol of an era of excess and foolishness. But Pets.com wasn't alone or even unusual. Let's talk about Webvan, which had even larger ambitions and even more spectacular failure. Webvan wanted to revolutionize grocery shopping by delivering groceries to your door within a 30-minute window of your choosing. They raised $400 million from venture capitalists and another $375 million in their IPO. They built massive, state-of-the-art warehouses, not just one, but multiple facilities in different cities, each costing tens of millions of dollars. They bought fleets of trucks. They hired thousands of employees. They created sophisticated software to manage orders and routes and inventory, and the service was amazing by all accounts. You could order groceries online, choose a delivery window, and your groceries would arrive fresh and well-packed exactly when promised. The drivers were friendly. The selection was good. If you were a customer, you loved Webvan, but you probably weren't a customer because the service was only available in a few cities, and even in those cities, most people didn't use it. They continued going to grocery stores because it was habit, or because they wanted to pick their own produce, or because they didn't think to try something new. And for the small percentage of people who did become Webvan customers, each order lost money for the company. The groceries were sold at regular grocery store prices, which meant thin margins. The cost of warehousing, picking orders, and delivering them erased those margins and then some. Webvan needed massive volume to make their model work, and they never achieved it. They filed for bankruptcy in July 2001, having burned through more than $800 million. The enormous warehouses were sold at fire sale prices. The trucks were auctioned. More than 2,000 employees were laid off. It was an ambitious vision executed competently, but based on economics that never made sense at the scale they needed. Then there was Cosmo.com, which promised to deliver small items, snacks, drinks, magazines, DVDs, video games, to your door in under an hour for free with no minimum order. Think about that promise for a moment. You could order a single candy bar and someone would bring it to your apartment within an hour and you wouldn't pay for delivery. How could this possibly work as a business? The delivery cost alone for each order was several dollars. If you ordered $10 worth of items and Cosmo had maybe a 20% margin on those items, they made $2 but spent $5 or $6 on delivery. They lost money on every transaction. The theory was that customers would order frequently enough and order enough high-margin items that somehow it would work out. It didn't. Cosmo raised hundreds of millions of dollars and shut down in March 2001, having never found a path to profitability. There were dozens of companies like this, maybe hundreds. Flues and Beans, which tried to create alternative online currencies, eToys, which sold toys online and competed with Amazon but had worse economics, Furniture.com, Garden.com, Eve.com for beauty products, Darkoop.com for health information. Each had a reasonable sounding premise. People might want to buy these things online. Each spent enormous amounts of money trying to build brand awareness and customer base, and each failed to find a sustainable business model. But here's what's important to understand. At the time, in 1998 and 1999, these companies were valued at hundreds of millions or billions of dollars. Webvan's market capitalization at its peak was over $1 billion. eToys reached a valuation of nearly $8 billion, more than Toys R Us, the dominant physical toy retailer. Pets.com was valued at $300 million at its IPO. These weren't niche companies known only to insiders. They were mainstream, advertised heavily, covered in the press, held up as examples of the new economy. And then there were the really absurd examples, the ones that in retrospect seem impossible to believe, but that at the time were taken seriously. Pizza delivery websites that allowed you to order pizza online from your local pizza place. The websites didn't make the pizza, didn't deliver the pizza, didn't do anything except provide the online interface and take a small fee for passing the order to the pizza place. This was a convenience, sure, but was it worth hundreds of millions of dollars? Several companies in this space raised tens of millions in venture capital funding. One company's valuation reportedly reached several $100 million for a website that let you order pizza. Or consider the business-to-business companies, the B2B startups that were even less exciting than retail, but that commanded even higher valuations for a while. These were companies that wanted to create online marketplaces for businesses to buy supplies, office supplies, chemicals, components, raw materials, whatever. The theory was that businesses spent billions buying supplies, and if you could capture even a small percentage of those transactions, you'd make a fortune on the fees. Companies like Commerce One and Ariba and dozens of others raised hundreds of millions in funding and had market capitalizations in the billions. They built elaborate platforms and signed up some real customers. But the actual transaction volumes were tiny compared to what was needed to justify the valuations. And the margins were razor thin because businesses negotiated hard on price. Most of these companies eventually failed or were acquired for fractions of their peak values. The strategy that everyone followed was called Quote 7. This phrase was used constantly in business plans, in pitch meetings, in conversations between entrepreneurs and investors. Get big fast. Grow your customer base as quickly as possible. Achieve scale before competitors do. Dominate your market segment. Don't worry about profit margins. Don't worry about unit economics. Don't worry that you're spending $5 to acquire each customer who might spend $10 total over their lifetime. Just get big fast. Because being big means you win, and winning means you'll eventually figure out how to be profitable. This strategy made sense for a very small number of companies, genuine platforms with real network effects, where being first and biggest created lasting advantages. But it was applied to everything, including companies where scale didn't help much. An online pet food store doesn't benefit that much from being twice as large as a competitor. The costs scale roughly linearly with revenue. There's no magical tipping point where suddenly the economics work. But this logic was ignored in the rush to grow, to capture market share, to become the dominant player before competitors did. The internal cultures of these companies reflected the boom mentality. Startups hired aggressively, sometimes doubling their employee count every few months. They rented fancy office space in expensive cities. They provided free food, game rooms, generous benefits. The work was intense, long hours, constant pressure to ship new features and grow faster, but it was also exciting. Employees, especially early ones, received stock options as part of their compensation packages. These options gave them the right to buy company stock at a fixed price, and if the company went public at a much higher price, the options could be worth a fortune. Let me explain how this worked. Because stock options became a central part of dot-com culture and mythology. Imagine you join a startup as employee number 20. The company gives you options to buy 10,000 shares at $1 per share. At the time, the company is private and the shares are essentially worthless, just a theoretical value. But if the company goes public and the stock trades at, say, $30 per share, your options are suddenly worth $290,000. You pay $10,000 to exercise the options, buying the shares at $1 each, then immediately sell them for $30 each, pocketing the difference. Multiply this across dozens or hundreds of employees, and you have a situation where administrative assistants and engineers and middle managers are becoming paper millionaires overnight when their companies go public. This created a powerful incentive structure. Employees worked long hours, believed in the mission, recruited their friends because they thought they were building toward a life-changing payday. And for employees at a few companies, Amazon, eBay, Yahoo, Google later, this actually happened. Their options made them wealthy. But for employees at most startups, the options eventually became worthless when their companies failed or their stock prices collapsed. The dream of instant wealth through stock options was mostly that, a dream. But it was a powerful motivator while it lasted. The IPO market became overheated. Companies were going public earlier and earlier, with less and less proven. In the past, a company might wait until it was mature, established, reliably profitable before going public. But in the late 90s, companies went public at younger and younger stages. 18 months from founding, 12 months. Some companies went public before they had meaningful revenue. The investment banks that managed IPOs were happy to bring these companies public because they earned fees for doing so, and because there was voracious investor demand. Every IPO seemed to double or triple on the first day of trading, which created headlines and excitement and demand for the next IPO. Ordinary people got caught up in this too. Day trading became a phenomenon. People who had regular jobs started spending their lunch breaks or evenings trading stocks online through E-Trade or Ameritrade or other online brokers. Some people quit their jobs to day trade full-time, believing they could make a living buying and selling internet stocks. There were stories of housewives who turned small accounts into hundreds of thousands of dollars, college students who made more trading stocks than they could make at any entry-level job. The stories were real. Some people did make money, at least for a while, but they were also highly selective. For every person who made a fortune day trading, there were many more who lost money, but those stories didn't get told as often. The feedback loop was complete. Rising stock prices made people want to invest in stocks, which pushed prices higher, which attracted more investors, which pushed prices higher still. Companies used their high stock prices to acquire other companies or to raise more money by selling more shares. The money raised was used to grow faster, acquire more customers, build more infrastructure, which made them seem more valuable, which pushed their stock prices higher. Round and round it went, a self-reinforcing cycle that seemed like it could continue indefinitely as long as everyone kept believing. And most people did keep believing, through 1998, through 1999, right up until the beginning of 2000. There were skeptics, of course. Some investors and analysts said that valuations were insane, that most of these companies would fail, that we were in a bubble. There was a famous article in Barron's in March 2000 titled, quote, Zolt, that listed dozens of internet companies and calculated how many months of cash they had left at their current burn rates. The implications were stark. Many companies would run out of money within the year. But these warnings were dismissed by true believers as old economy thinking, as failure to understand the transformational nature of what was happening. The true believers had a point, in a way. The internet was transformational. But transformation doesn't mean every company succeeds. Automobiles transform society, but hundreds of car companies failed before the industry consolidated around a few survivors. Electricity transformed the world, but most electricity companies from the early 20th century are long gone. The technology can be revolutionary while most companies built around that technology still fail. This is a hard truth to accept when you're in the middle of it, when you're excited and optimistic and your portfolio is up 50% or 100% or more. Why listen to skeptics when you're winning? When every month brings new highs? When everyone around you is making money and talking about the future and dismissing the doubters as people who just don't get it? So the bubble inflated through 1998 and 1999, growing larger and stranger and more detached from any rational assessment of value, but feeling at the time like progress, like the future arriving exactly as it should. The collapse was coming. It was inevitable, really, once the disconnect between valuations and reality grew large enough. But we're not there yet. For now, at the end of 1999, the party is still going, the champagne is still flowing, and hardly anyone wants to hear that it can't last. Let that moment rest in your mind, the peak of optimism, the height of belief, the last moments before everything changes. Because change is coming, sooner than anyone expects. As we move into the final months of 1999 and into the early days of the year 2000, we reach the peak of the bubble, the moment when things became so strange that future generations would struggle to believe the stories were true. This was when a sock puppet became more recognizable than most corporate executives, when 17 online companies spent over $2 million each for a single 30-second advertisement during the Super Bowl. When newspaper delivery boys and college students were starting companies that venture capitalists valued at tens of millions of dollars. When the disconnect between fantasy and reality grew so wide that you could drive a truck through it, except everyone was too busy getting rich on paper to notice the gap. Let's talk about the Super Bowl, because it captures the moment perfectly. The Super Bowl has always been the most expensive advertising venue in American television. Companies pay premium prices because over 100 million people watch, and because a Super Bowl ad carries prestige, signals that you're a major brand. Traditionally, Super Bowl advertisers were established companies, beer brands, car companies, soft drinks, snack foods. These were businesses with real products, real customers, real profits, spending their advertising budgets to maintain market share and build brand loyalty. But Super Bowl 34 in January 2000 was different. 17 dot-com companies bought Super Bowl ads. 17. Companies that in many cases had been founded less than 2 years earlier. Companies that had never made a profit and had no clear path to profitability. Companies whose names most viewers had never heard before and would never hear again after the company shut down a year later. But there they were, during the biggest television event of the year, spending $2 to $3 million for 30 seconds of airtime, plus often another million or two to produce the commercial itself. The Pets.com sock puppet appeared during the Super Bowl, singing along to a song, riding in a microphone-shaped car. The ad was charming and funny. People remembered it. The sock puppet became a minor celebrity, appearing on talk shows, at events and parades. But all that brand awareness didn't translate into sustainable business. The company was still losing money on every sale. The Super Bowl ad brought in more customers, which meant losing money faster. Within 10 months, Pets.com would announce it was shutting down. The sock puppet outlived the company in the public consciousness. People still reference it decades later as a symbol of the era, which is both amusing and sad. Monster.com, the job search site, bought an ad showing children talking about what they wanted to be when they grew up, but instead of saying astronaut or doctor, they said things like quote 9, quote 10, quote 11. The tagline was quote 11. It was clever, well executed, and Monster.com was actually one of the more legitimate internet businesses, providing a service that made sense online. But even legitimate companies were spending money at rates that seemed designed to prove they could. Not because it made financial sense. Our Beginning.com, a company that created wedding announcement websites, bought a Super Bowl ad. Think about that business model for a moment. Wedding announcements, online. This was going to be a business worth spending millions of dollars advertising during the Super Bowl. Computer.com, Hotjobs.com, Epidemic.com, companies that most viewers had never heard of and would never think about again. All there during the most expensive advertising showcase in America, burning through venture capital money at astonishing rates. The Super Bowl ads were a symptom of a broader phenomenon. .coms were spending money as if it were infinite, as if the venture capital funding rounds would never stop. As if going public would always be an option, and would always result in stock price doubling or tripling. The phrase quote 12 entered common usage. It referred to how much money a company was spending per month beyond its revenue. A company with $3 million in the bank and a burn rate of $500,000 per month had 6 months of runway. 6 months to either become profitable, raise more money, or shut down. During the peak of the bubble, burn rates were worn almost like badges of honor. A high burn rate meant you were growing fast, spending aggressively. Building towards dominance, it suggested ambition and scale. The fact that it also suggested possible disaster was downplayed or ignored. Silicon Valley real estate became absurdly expensive. Office space that might have rented for $20 per square foot per year in the early 90s was suddenly going for $60 or $80 or $100 per square foot. Startups were signing leases for entire floors of buildings, sometimes multiple floors, to accommodate their rapidly growing headcounts. The landlords were happy to sign these leases with young companies that had no revenue, because those companies had venture capital backing, which meant they could pay rent for a while at least. And if the company went public, the landlord was sitting on a lease with a newly wealthy tenant who might take even more space. Residential real estate in Silicon Valley went through a similar boom. Engineers and executives at startups had stock options that might be worth millions if their companies went public. Even though the options weren't liquid yet, even though they were just paper wealth, people borrowed against that potential. They bought houses in Palo Alto and Mountain View and Menlo Park. Small houses that might have cost $300,000 in the early 90s were suddenly selling for $700,000 or $1 million or more. Young people in their 20s were buying houses that their parents couldn't have afforded at the same age, betting that their stock options would vest and their companies would go public, and the money would materialize to pay off the mortgages. The parties were legendary. Startup companies threw lavish events to celebrate funding rounds or product launches, or sometimes just because it was Thursday. They'd rent out clubs or restaurants, provide open bars, hire DJs or live bands, give away company-branded merchandise. The ostensible purpose was team building or recruiting or networking, but really they were celebrations of having money and being part of something exciting. The dress code was famously casual, jeans and t-shirts and sneakers, a deliberate rejection of the suits and ties of traditional corporate America. This was the new economy, and it had its own aesthetic, its own culture, its own sense of being cooler and more innovative than the old economy it was supposedly replacing. The cars in Silicon Valley parking lots reflected the wealth, both real and imagined. Porsches and BMWs and Mercedes, often leased rather than bought, driven by 25-year-old software engineers who a year earlier had been driving used Hondas. The cars were symbols of having made it, of being part of the boom, of the future that had already arrived for the lucky few. Whether the wealth would last, whether the stock options would retain value, whether the companies would survive, these were questions for later. Right now there was money to spend and status to signal. college dropouts became CEOs, which was both inspiring and concerning. The story of Bill Gates dropping out of Harvard to start Microsoft had become legend, and the 1990s produced new versions of this narrative. People in their early 20s with technical skills but no business experience were founding companies and raising millions of dollars and being taken seriously by investors and the press. Some of them were genuinely talented and visionary. Others were kids who happened to be in the right place at the right time with an idea that sounded plausible in a pitch meeting. The venture capital firms that funded these young CEOs told themselves they were pattern matching, finding the next Bill Gates or the next Steve Jobs. But there's a survivorship bias in this kind of thinking. We remember the college dropouts who succeeded because they're notable. We forget the hundreds or thousands who dropped out and failed because failure is common and unremarkable. During the bubble, the success stories were emphasized and the failure stories were ignored, which created an unrealistic picture of how likely success was. The European bubble was happening simultaneously, with its own particular absurdities. Boo.com was perhaps the most spectacular European failure. Founded in 1998 by 3 Swedish entrepreneurs, Boo.com wanted to be a global online fashion retailer, selling branded clothing and sporting goods. They raised $135 million from investors, an enormous sum for the time. They hired hundreds of employees across multiple countries. They created an elaborate website with 3-dimensional technology to show products from multiple angles, which was innovative but also required high bandwidth that many users didn't have. The site was slow, difficult to use, and crashed frequently. Boo.com spent money at rates that made even other .coms look conservative. The founders flew first class, stayed in luxury hotels, hired aggressively, spent heavily on marketing. They launched simultaneously in multiple countries rather than starting in one market and expanding, which meant overhead costs were multiplied. The website launched months late, after multiple delays, and when it finally went live in November 1999, it was buggy and slow. Sales were far below projections. The company burned through its funding in 18 months and went bankrupt in May 2000. Becoming a cautionary tale about excess and poor execution. The founders were young and inexperienced, and they were given more money than they knew how to manage responsibly. The investors who funded them bear responsibility too, for not providing better oversight and for buying into a vision that was more fantasy than business plan. But let's return to America, to the peak of the bubble in late 1999 and early 2000. The Nasdaq Composite Index, which tracked technology stocks, had been rising steadily through the 90s but accelerated dramatically in 1999. In January 1999, the Nasdaq was around 2,400. By December, it had reached 4,069, a gain of nearly 70% in a single year. This was extraordinary. The stock market historically returns about 8 to 10% per year on average. 70% in a year was not normal. It was a sign that something was seriously disconnected from reality, and the rise continued into 2000. In January, the Nasdaq kept climbing. In February, it climbed more. By early March, it seemed unstoppable. And then on March 10th, 2000, the Nasdaq Composite Index reached its all-time peak of 5,048.62. Let that number settle for a moment. 5,048.62. From that peak, it would fall nearly 80% over the next 2.5 years. But standing there on March 10th, looking at the charts, few people thought this was the top. Most people thought it was a milestone, a moment to celebrate before continuing upward. The valuations at the peak were disconnected from any traditional measure of value. Price-to-earnings ratios, the standard way of measuring whether a stock is expensive or cheap, were meaningless for most internet stocks because there were no earnings. So analysts came up with alternative metrics, price-to-sales ratios, which looked at the stock price relative to revenue even if the company was losing money. Price-to-eyeballs, measuring valuation against website visitors, price-to-page views. These metrics were attempting to value companies that had no profits and in some cases no realistic path to profits, which is a fundamentally difficult task. eToys, the online toy retailer, reached a market capitalization of nearly $8 billion in October 1999. Toys R Us, the dominant physical toy retailer with hundreds of stores and actual profits, was worth about $6 billion. The market was saying that a startup that shipped toys from a warehouse and lost money on every sale was worth more than an established profitable business with a nationwide presence. This made no sense by any traditional analysis, but the market wasn't using traditional analysis. The market was pricing the future, and the future belonged to internet companies, or so everyone believed. Priceline.com, which let users name their own price for airline tickets and hotel rooms, went public in March 1999. On the first day of trading, the stock price gave the company a valuation of nearly $10 billion. The company had revenue, which was good, but it was essentially a middleman taking a cut of transactions. The margins were thin, the customer acquisition costs were high, and it wasn't clear how sustainable the business was. But the stock soared anyway, because it was a .com and therefore valuable by definition. The narrative that justified all of this was the new economy versus old economy framing. The old economy was manufacturing, retail, traditional services, businesses that had existed for decades or centuries, that operated on proven models that made actual profits. The new economy was digital, internet-based, unconstrained by physical limitations. The old economy was slow and bureaucratic. The new economy was fast and innovative. The old economy was destined to be disrupted. The new economy was the future. This framing made anyone who questioned valuation seem like a dinosaur, someone stuck in the past who didn't understand that everything had changed. But everything hadn't changed. The fundamentals of business: you need to bring in more money than you spend. You need to create value that customers will pay for. You need unit economics that work at scale. These hadn't changed. They were just being ignored in the excitement of the moment. The idea that a company could lose money indefinitely while growing revenue, and that someday, somehow, profits would materialize, this was hope, not strategy. For a few companies, it worked. Amazon lost money for years while building infrastructure and market share, and eventually became hugely profitable. But Amazon was the exception, not the rule. Most companies that followed the quote 13 strategy never made it to the profit part. Customer acquisition costs were often higher than customer lifetime value, which is a formula for disaster. If it cost you $100 in marketing and discounts to acquire a customer, and that customer spends $75 with you over their lifetime before going elsewhere, you've lost $25 per customer. You cannot make that up at scale. But many .coms had exactly this problem. They were spending heavily to acquire customers through advertising, subsidizing purchases with below-cost pricing, offering free shipping, and hoping that somehow the customers would become profitable over time. Some customers might become profitable, but on average the math didn't work. The human side of all this is important to understand, because this wasn't just about abstract financial metrics. Real people were making real decisions based on what seemed like rational assessments at the time. Consider the person working at a traditional company, maybe a bank or a manufacturing firm or a retail chain. Stable job, decent salary, benefits, retirement plan. Everything their parents would have advised them to value, but their college roommate just joined a startup and got stock options and is talking about becoming a millionaire when the company goes public. Their cousin is day trading internet stocks and making more in a month than they make in a year. The newspaper has articles about 23-year-old vice presidents at .coms. Everyone around them seems to be getting rich, or at least positioning themselves to get rich, and they're just going to work every day at their stable, boring job. So they quit. They join a startup, taking a pay cut but getting stock options that might, just might, be worth a fortune. Or they cash out their retirement savings and invest in internet stocks, convinced that this is the opportunity of a lifetime. or they start their own company, leave the safety of employment to become an entrepreneur, to build something, to be part of this moment. These decisions made sense to them at the time. They weren't stupid or reckless. They were responding to what they saw around them, to the stories they heard, to the apparent evidence that the internet was creating massive wealth, and that participating in it was the smart move. The warning signs were there if you looked. Some respected investors and analysts were saying the market was overvalued. Warren Buffett, the famous value investor, was notably absent from internet stocks, saying he didn't invest in businesses he didn't understand. His firm, Berkshire Hathaway, had lagged the market returns during the late 90s, which led some people to suggest that maybe Buffett was past his prime, that he didn't understand the new economy, that his value investing approach was obsolete. This criticism of one of the most successful investors in history was itself a sign of how distorted thinking had become. But Buffett's skepticism was dismissed by many as old fogey thinking. The Barron's article in March 2000, titled Quote 14, did detailed analysis on internet companies' cash positions and burn rates. It calculated that dozens of companies would run out of money within 12 months at their current spending rates. The article caused some concern, a small dip in stock prices, but then the market recovered and continued upward for a few more days. The warnings were acknowledged but not heeded. There was always a reason to dismiss the skeptics. They didn't understand network effects. They didn't appreciate first-mover advantage. They were applying old metrics to new businesses. They would be proven wrong when these companies dominated their markets and became hugely profitable. The parties continued. The hiring continued. The spending continued. The stock prices continued rising, at least for a few more weeks. Real estate continued appreciating. People continued quitting stable jobs to join startups. Venture capitalists continued funding new companies. The feedback loop was still intact, still reinforcing itself, still creating the appearance of unstoppable momentum. But momentum is not the same as foundation. Something built on momentum alone, without solid footing underneath, will eventually fall. The only question is when. Standing at the peak in early March 2000, nobody knew that this was the peak. Some people thought stocks were overvalued but would keep rising anyway because of momentum. They planned to sell soon, but not yet. Others thought valuations were justified by the transformational nature of the internet. Still others didn't think about it much at all, just watched their portfolios grow and assumed it would continue. Very few people thought that the top was in, that the market would start falling and not stop falling for 2.5 years, that trillions of dollars in market value would evaporate, that most of these companies would go bankrupt. But that's the nature of peaks. You can only identify them in retrospect. At the time, they just feel like another day, maybe a particularly good day, but not the last good day. The end of the party, when it comes, often arrives quietly at first, without drama or announcement. Just a change in the music, a shift in the mood, people starting to check their watches and think about heading home. That's where we are now, standing at the peak on March 10th, 2000, with the Nasdaq at 5,048.62, with internet stocks at their highest valuations, with optimism at its zenith, with belief at its strongest. The bubble has inflated as far as it will inflate. What comes next is the deflation, slow at first, then faster, then catastrophic. But we'll get to that. For now, let this moment rest. The peak of the bubble, the height of the madness, the last moment when it all seemed possible, when the future seemed limitless, when everyone believed. Take a breath and let it settle, because it's the last moment of innocence before reality reasserts itself. The peak on March 10th, 2000 wasn't recognized as a peak when it happened. The Nasdaq Composite reached 5,048.62 that day, then closed slightly lower, which seemed like nothing unusual. Markets go up and down. A small dip after a long rally was expected, maybe even healthy. Nobody rings a bell at the top of a market. There's no announcement that says quote 15. You only know it was the peak when you look back months or years later and realize that was the moment everything changed. The following days and weeks saw the Nasdaq drift lower. Not dramatically at first. Down 1% one day, up 0.5% the next, down 2%. Up 1. The kind of volatility that traders had gotten used to. Internet stocks were always volatile. They swung up and down by large percentages on any given day. So a period of choppiness after a long rally didn't necessarily mean anything. Well, that's what people told themselves. That's what they wanted to believe. But the decline continued. By the end of March, the Nasdaq was down about 9% from its peak. By mid-April, it was down about 25%. This was starting to feel less like a correction and more like something else, though nobody wanted to say the word that was beginning to creep into people's minds: crash. Because crashes are dramatic events, sudden drops that happen in days. This was slower, more of a grinding decline punctuated by occasional rallies that made people hope the worst was over. Those rallies were cruel in a way, because they gave false hope. The market would rise for a day or two, and people would think quote 16, and they'd hold on to their stocks or even buy more. Then the decline would resume. The explanations for the decline varied depending on who you asked. Some said it was just a healthy correction, a necessary consolidation after the rapid gains of 1999. The market had gotten ahead of itself and needed to come back to earth a bit before resuming its upward trajectory. This was a normal part of market cycles, nothing to worry about. Hold on, and you'd be fine. This explanation was comforting, and many people believed it because they wanted to believe it. Others pointed to specific events or concerns. The Federal Reserve had been raising interest rates to cool down the economy and prevent inflation. Higher interest rates made borrowing more expensive and made bonds more attractive compared to stocks, which could explain why money was flowing out of the stock market. Or maybe it was concerns about the presidential election coming up in November. Political uncertainty sometimes made markets nervous. Or maybe it was worries about the Y2K problem, the fear that computers would malfunction when the calendar rolled over to the year 2000 had created anxiety in 1999. And even though Y2K had turned out to be a non-event, maybe there were lingering concerns about technology reliability. These explanations all sounded reasonable. They gave people something to point to, some external factor that was causing the decline, which implied that when that factor resolved, the market would recover. But the real reason was simpler and more fundamental. Valuations had gotten completely disconnected from reality. And reality was beginning to reassert itself. The companies that had been valued at billions of dollars with no profits and often no clear path to profits, the market was starting to question whether those valuations made sense. And once doubt enters a bubble, once people start asking, quote, 17, quote, the bubble begins to deflate. Some companies started failing, which added to the nervousness. These weren't the biggest, most prominent companies yet, but they were real businesses that had raised real money and were now shutting down. Boo.com, the European fashion retailer we talked about earlier, went bankrupt in May 2000 after burning through $135 million in 18 months. The failure was covered in the press, and it raised uncomfortable questions. If a company could raise that much money from sophisticated investors and still fail so quickly, what did that say about investor judgment? What did that say about the business models that were being funded? Other companies announced layoffs, not closures, but reductions in staff to cut costs and extend their runway. This was a sign that the easy money was getting less easy, that venture capital firms were becoming more cautious about which companies to fund and how much to give them. The companies that had been hiring aggressively, doubling their headcount every few months, suddenly stopped hiring or even reversed course. The job market in Silicon Valley, which had been impossibly tight with engineers able to choose among multiple offers, started to loosen slightly. Not a lot, not yet, but enough that people noticed. Let's talk about lock-up periods, because they became important during this time. When a company goes public, the early investors and employees who own shares before the IPO are typically subject to a lock-up period, usually 90 days or 180 days, during which they're not allowed to sell their shares. This prevents insiders from immediately dumping their stock onto the public market, which could crater the price. The lock-up period gives the stock time to find its natural level with public buyers and sellers. But when the lock-up period expires, insiders are free to sell. And in many cases, they want to sell because they've been watching their paper wealth fluctuate wildly and they want to lock in gains while they can. Or they need to sell to diversify their holdings or pay taxes on stock options they've exercised. When lock-up periods expired for some of the internet companies that had gone public in 1999, large amounts of stock suddenly became available for sale. This created selling pressure that pushed prices down. The dynamic was self-reinforcing. Insiders saw the market declining and wanted to sell before prices fell further. Their selling pushed prices down, which made other shareholders nervous and want to sell, which pushed prices down more. The opposite of the virtuous cycle that had driven prices up. Now it was a vicious cycle driving them down. And unlike the way up, where rises can continue for months or years as enthusiasm builds, the way down is often faster, because fear is a more powerful emotion than greed, and because once the momentum shifts, there's no reason to hold a stock you only owned because it was going up. Public market valuations and private valuations started to diverge noticeably. A startup that was raising money from venture capitalists might be valued at, say, $100 million in a private funding round. But comparable public companies were seeing their stock prices fall, which meant their market capitalizations were shrinking. If public company A was worth $500 million in March and was now worth $200 million in June, and your private company was supposedly worth $100 million, was that valuation still realistic? The answer was increasingly no. But private valuations are sticky. They don't adjust as quickly as public stock prices because there's no daily market providing price discovery. So you had a growing gap between what private companies thought they were worth and what the public markets were saying similar companies were worth. This gap had real consequences. Companies that had been planning IPOs started postponing them. If you're a startup that was valued at $200 million in your last private funding round, and you're planning to go public, you want the public market valuation to be at least as high, preferably higher. But if comparable companies are seeing their market caps fall by 50 or 70%, your IPO is likely to price below your private valuation, which is embarrassing and dilutes existing shareholders. Better to wait until the market recovers. So IPOs got pushed back from spring to summer, then from summer to fall. Then from fall to quote 18, some were cancelled outright. The IPO market, which had been red hot in 1999 and early 2000, cooled dramatically. This mattered because the IPO was the ultimate exit for venture capital investors and startup employees. It was how paper wealth became real wealth. If you couldn't go public, you were stuck with the liquid shares in a private company, which might be worth a lot on paper, but which you couldn't sell. The closure of the IPO window was like a door slamming shut, trapping people inside with their paper wealth, while the valuation of that paper wealth steadily declined. Venture capital funding started to slow down, not dramatically yet, but noticeably. In the first quarter of 2000, venture capital firms had invested over $27 billion in startups. In the second quarter, it was still high, but slightly lower. By the third quarter, it would be lower still. The VCs were becoming more selective, asking harder questions, demanding more evidence of viable business models before writing checks. The era of funding anything with .com in the name was ending. Now you needed to show a path to profitability, or at least to break even, or at least to not burning money quite so fast. For companies that were running low on cash, this was a serious problem. Remember, most internet startups were losing money every month. That was their burn rate. They depended on raising new rounds of funding every 12 or 18 months to keep operating. If the funding environment tightened just as they needed to raise money, they were in trouble. Some companies started cutting costs aggressively to extend their runway, to make the money they had last longer, in hopes that the funding environment would improve. Others tried to sell themselves to larger companies for whatever price they could get. Still others just quietly shut down, laying off staff and returning whatever money was left to investors. The mood in Silicon Valley shifted from triumphant to uncertain. The parties became less frequent. The free food and generous perks at startups started to seem like unnecessary expenses that should be cut. The Porsches in the parking lots were still there, but the leases were looking like increasingly bad decisions. The real estate market softened slightly as people who had stretched to buy houses based on expected stock option wealth started to worry about whether that wealth would materialize. It wasn't panic yet, not widespread fear, just a growing sense of unease, a feeling that maybe things weren't going to work out exactly as planned. People who had sold their stocks early, who had cashed out in 1999 or early 2000 and been criticized at the time for selling too soon, started to feel vindicated. They'd been called cowards or unbelievers, accused of not understanding that you had to hold for the long term to realize the real gains. But they had money in the bank while everyone else had stocks that were worth less every week. Their caution was looking smarter and smarter. Though of course some of them felt regret too. They'd sold, yes, but they'd sold too early before the peak and they'd missed out on the final gains. This is the curse of investing. It's almost impossible to time things perfectly, and you always second-guess your decisions. People who had held onto their stocks, especially those who had bought more during the rise in late 1999, were getting nervous. They'd seen their portfolios double or triple, but now they were watching those gains evaporate. The question everyone was asking themselves was, do I sell now and lock in whatever gains remain, or do I hold on because this is just a temporary dip? It's an impossible question to answer in the moment. If you sell and the market recovers, you'll feel like a fool for selling at the bottom. If you hold and the market keeps falling, you'll feel like a fool for not selling while you still had gains. There's no right answer, or rather, the right answer only becomes clear in retrospect. The financial media started asking uncomfortable questions, slowly at first. Articles appeared wondering whether some internet valuations were too high. Analysts who had maintained buy ratings on everything started downgrading a few stocks to hold or even sell. CNBC, which had been breathlessly covering every new internet IPO and every new high in the Nasdaq, started having segments about market corrections and whether the dot-com sector was overvalued. The tone shifted from celebration to concern, though not yet to alarm. The message was, be careful, be thoughtful, maybe take some profits, but this wasn't necessarily the end of the world, just a rough patch that would pass. Some people kept the faith. They believed that the internet was still transformational, that the fundamentals hadn't changed, that this was just a temporary setback before the next leg up. They pointed to Amazon, which was down from its peak but was still a real company with growing revenue. They pointed to eBay, which was still profitable and growing. They argued that the market was overreacting, that it had thrown the baby out with the bathwater. The quality companies were being unfairly punished along with the junk, and they had a point. Not every internet company was doomed, and some were legitimate businesses that would survive and thrive. But telling the difference between the survivors and the failures was harder than it seemed, especially when you owned stock in a company and wanted to believe it would be okay. By late summer 2000, the Nasdaq had stabilized somewhat. It was down significantly from the March peak. Down about 30 or 35%, but it had stopped falling quite so steeply. There was a rally in late summer that got people hopeful again. Maybe the worst was over. Maybe this was the bottom. Maybe the market had found its footing and would start climbing again. This is what people wanted to believe, and there were enough positive signs that you could construct a narrative around recovery if you tried. But underneath the surface, the fundamentals were still broken. The companies that had bad business models still had bad business models. The firms that were burning through cash still needed funding. And funding was getting harder to obtain. The easy money was gone. The willingness to fund companies with no path to profitability was gone. The belief that growth alone justified any valuation was gone. These were not temporary changes that would reverse when the market recovered. These were permanent shifts in how internet companies would be evaluated going forward. The people living through this time didn't know what was coming. They didn't know that the decline would continue on and off for another 2 years. They didn't know that the Nasdaq would eventually fall another 50 or 60% from where it was in summer 2000. They didn't know that most of the companies they'd invested in or worked for would eventually shut down. They were living in the uncertainty, trying to make decisions with incomplete information, hoping they were making the right choices. Some were worried, some were still optimistic. Most were somewhere in between, worried but hopeful, concerned but not yet ready to abandon their beliefs about the internet's potential. This is the nature of being in the middle of a crisis. You can feel that something is wrong, but you can't see how wrong, how bad it will get, how long it will last. You make your best guesses and hope you're right. And sometimes you are right, and sometimes you're catastrophically wrong, and you only know which after the fact. For now, in the summer of 2000, with the Nasdaq down from its peak but not yet collapsed, with some companies failing but others still hiring, with uncertainty but not yet panic, people were trying to figure out what to do. Hold or sell, stay at the startup or look for a more stable job, keep believing or cut your losses. These weren't easy questions, and there were no easy answers. Let yourself sit with that uncertainty for a moment, that feeling of not knowing what comes next, of hoping it will be okay, but fearing it might not be. That's where millions of people were in the summer of 2000, standing at the edge of something they couldn't quite see yet. Something that was about to become much clearer and much more painful. The uncertainty of summer 2000 gave way to something harder and more definite in the fall. The companies that had been struggling, that had been cutting costs and extending runway and hoping for funding that wasn't coming, they started to fail. Not all at once, but in a steady drumbeat of announcements. Company X is shutting down operations. Company Y is filing for bankruptcy. Company Z has laid off 80% of its staff. Each announcement was a small tragedy. Dozens or hundreds of people losing their jobs, investors losing their money, dreams dying. And the announcements came week after week, month after month, until they stopped being surprising and started being expected. Pets.com was one of the most visible failures, partly because the sock puppet had made the brand so recognizable. In November 2000, less than a year after that Super Bowl commercial, less than 9 months after the IPO, Pets.com announced it was shutting down. The company had burned through $300 million. The stock, which had peaked at $14 per share, was trading at pennies. On the last day of trading, you could buy a share of Pets.com for 19 cents. All those investors who had bought in the IPO or bought during the brief period when the company seemed like it might succeed, they lost everything. The employees, many of whom had taken pay cuts and stock options to join what they thought would be a successful company, lost their jobs and their paper wealth simultaneously. The sock puppet was auctioned off as part of the company's liquidation. The domain name Pets.com was eventually sold. The warehouses were closed, the inventory was liquidated, and within weeks it was as if the company had never existed except as a cautionary tale. The speed of the collapse was remarkable, from IPO to bankruptcy in 9 months, from Super Bowl advertiser to nothing in 10 months. All that money, all that effort, all that optimism, gone. With almost nothing to show for it except a famous sock puppet that outlived the company. But Pets.com was just one of many. eToys, which had been valued at nearly $8 billion at its peak, filed for bankruptcy in March 2001. The company actually had a decent business selling toys online, and at one point had been profitable or close to it. But they'd expanded too aggressively, spent too much on marketing and infrastructure, assumed growth would continue forever. When growth slowed and funding dried up, they couldn't adjust fast enough. The debt they'd taken on during the boom years became crushing during the bust. They tried to restructure, tried to find a buyer, tried everything they could think of to survive. Nothing worked. The company shut down, laid off everyone, and the brand was eventually sold for a fraction of what it had once been worth. Webvan, which we've talked about before, held on longer than many but failed even more spectacularly. The company filed for bankruptcy in July 2001, having burned through $800 million. Those massive automated warehouses they'd built, each costing tens of millions of dollars, were sold at auctions for pennies on the dollar. The fleets of delivery trucks were liquidated. More than 2,000 employees were laid off. The company had been operational in multiple cities, delivering groceries to thousands of customers who genuinely loved the service. But the economics never worked. The more customers they served, the more money they lost. Scaling up just meant losing money faster, and when the funding stopped, there was no path forward. The dream of revolutionizing grocery delivery died, at least for that particular attempt. Cosmo.com shut down in March 2001. Boo.com had already failed in May 2000. Garden.com filed for bankruptcy. Furniture.com shut down. Eve.com closed. Dorkoop.com, named after the former Surgeon General, failed. The list went on and on. Companies that a year earlier had been featured in magazine articles and conference keynotes were now issuing press releases about cessation of operations. The pattern was almost always the same. We've been unable to raise additional funding, we've explored all strategic alternatives, we've made the difficult decision to cease operations, we're grateful to our employees and customers. The language was corporate and carefully worded, but underneath it was failure and loss and dashed hopes. Silicon Valley began to look like a ghost town in some areas. Office buildings that had been full of startups, with multiple companies per floor with waiting lists for space, suddenly had 4 lease signs in the windows. Entire floors sat empty. Landlords who had signed leases with .coms found themselves with tenants who couldn't pay rent, or who had gone bankrupt and vacated, leaving the landlord with nothing. The commercial real estate market, which had been impossibly tight during the boom, suddenly had the excess supply. Rents fell, but even at lower rates there weren't enough companies looking for space to fill the buildings. The residential real estate market softened too, though less dramatically. People who had bought houses in Palo Alto or Mountain View or San Francisco, expecting their stock options to vest and be worth millions, were now stuck with mortgages and no stock wealth. Some sold, often at a loss. Others held on, hoping the market would recover before they had to sell. The bidding wars and over-asking offers that had characterized the boom years disappeared. Houses sat on the market for months. It wasn't a crash like we'd see in the 2008 financial crisis, but it was a definite shift from seller's market to something more balanced, more normal, more like the world had been before the bubble. The job market reversed completely. Engineers who had been able to choose among multiple competing offers suddenly found themselves competing with dozens of other qualified candidates for each position. Recruiters who'd been desperately calling anyone with technical skills stopped calling. The signing bonuses, the generous stock option packages, the perks and benefits, all of those disappeared or were reduced. Companies that were still hiring, which were few, could now afford to be selective. Why pay a premium when talented people were available at normal salaries? The mass layoffs were devastating on a human level. Imagine working at a startup, believing in the mission, putting in long hours, sacrificing time with family and friends. Doing all of this because you believed you were building something important and because you thought your stock options would make you wealthy. And then one day you're called into a conference room and told the company is shutting down or doing massive layoffs, and you're being let go, effective immediately. Your stock options, which had seemed so valuable on paper, are now worth nothing. Your sacrifice was for nothing. The company you believed in has failed. And you're out of a job along with hundreds of others who are all looking for the same limited number of positions. This happened to thousands of people in late 2000 and 2001. People who had left stable jobs to join startups. People who had relocated to Silicon Valley for opportunities that no longer existed. People who had turned down offers from established companies because the startup seemed more exciting. more likely to make them rich. Now they were unemployed, their savings depleted, their confidence shaken. Some had to move back in with parents, some had to sell houses they couldn't afford, some left Silicon Valley entirely, moving to cheaper cities, taking jobs in different industries, leaving the tech world behind. The psychological impact was profound. These weren't just jobs being lost. These were identities. People had defined themselves as being part of something revolutionary, part of the internet transformation, part of the future. Losing that job meant losing that identity, that sense of purpose and importance, and the shame of it, the embarrassment of having believed in something that failed, of having made decisions that now seemed foolish. That was harder to bear than the financial loss, though the financial loss was real enough. For investors who had put their savings into internet stocks, the losses were catastrophic. Stocks that had been worth tens of dollars per share were now trading for pennies, or had been delisted entirely. Retirement accounts that had grown to impressive sizes during the bubble shrank back down or disappeared. The people who had quit their jobs to day trade full-time found that the strategy that had worked during the bubble, buy almost anything and it goes up, didn't work in reverse. You couldn't just short everything and make money, because the timing was tricky and the volatility was extreme. Many day traders lost everything they'd made and more. The venture capital firms that had funded these companies lost billions of dollars collectively. Individual VC funds that had raised money in 1998 or 1999 to invest in internet startups saw most of their portfolios go to zero. The partners at these firms, who had been celebrated as visionaries during the boom, were now being criticized for poor judgment and herd mentality. How could so many smart, experienced investors have made so many bad bets? The answer was that they'd gotten caught up in the excitement, abandoned their normal discipline, and convinced themselves that this time was different. It's an old story, repeated in every bubble throughout history, but it never feels like a bubble while you're in it. It always feels like a genuine opportunity that only you and the other smart people are wise enough to see. The Nasdaq, which had peaked at 5,048 in March 2000, kept falling through late 2000 and into 2001. By April 2001, it was below 2,000, down more than 60% from the peak, and it kept falling. The psychological level of 2,000, which seemed like it should be a floor, didn't hold. Down to 1,800, then 1,600, then 1,500. Every time it seemed like it might stabilize, something would trigger another leg down. An earnings report showing how badly a tech company was doing, a wave of bankruptcy announcements, a downgrade from an analyst, the selling fed on itself. And then September 11th. 2001 happened. The terrorist attacks on New York and Washington were a tragedy that transcended economics, but they had economic effects too. The stock market, which had been closed for several days after the attacks, reopened and fell sharply. Airlines, already struggling, were devastated. Travel stopped. Consumer confidence, already shaken by the recession that had begun earlier that year, fell further. The attacks added a layer of fear and uncertainty to a market that was already fearful and uncertain. The Nasdaq continued its decline through the rest of 2001 and into 2002. The bottom came in October 2002. On October 9th, the Nasdaq Composite closed at 1,114.11. From the peak of 5,048 to a bottom of 1,114, a decline of 78%. Nearly $4 trillion in market value had simply disappeared, vanished, gone. It wasn't that the money had moved somewhere else, it just ceased to exist. The wealth had been paper wealth, based on inflated valuations, and when those valuations corrected, the wealth disappeared like morning mist under the sun. Individual stocks fell even more than the index. Many internet companies that had been valued in the billions were now trading for pennies or had been delisted entirely. Amazon, one of the success stories, fell from over $100 per share at its peak to less than $6 per share at the bottom. the company came frighteningly close to bankruptcy. They had to raise debt financing at unfavourable terms. They had to prove they could be profitable, not someday but soon. Jeff Bezos, who had been celebrated as a visionary, was now being questioned about whether the company would survive. He held on, cut costs, focused on the fundamentals, and Amazon did survive. But it was a near thing. eBay, which had a better business model than most, still saw its stock fall from over $60 per share to around $10. Yahoo fell from over $120 per share to less than $10. Priceline, which had been valued at over $10 billion, fell to a market cap of just a few hundred million. The company came close to bankruptcy, had to restructure dramatically, and barely survived. These were the success stories, the companies that made it through. They still lost 80 or 90% of their value, still had to fire thousands of employees, still had to fundamentally rethink their businesses. The companies that didn't survive were too numerous to count. Hundreds of internet companies shut down between 2000 and 2002. Some of them had been real businesses with real revenue but unsustainable cost structures. Others had been little more than ideas with websites, companies that should never have been funded in the first place. But during the bubble, both types had been valued similarly, if you had a .com in your name and could articulate a plausible vision. You could raise money. Now those same companies were worth nothing, and the distinction between a real business and a fantasy became painfully clear. The accounting scandals that emerged during this period added to the sense of betrayal and crisis. Enron, which wasn't primarily a .com but which had used internet-style accounting and hype, collapsed in late 2001 in one of the largest bankruptcies in American history. The scandal revealed that executives had been lying about the company's financial health, that the auditors had failed to catch or had ignored the fraud, that supposedly sophisticated investors and analysts had been fooled or complicit. WorldCom, another telecom and internet infrastructure company, collapsed in 2002 in an even larger bankruptcy, also due to accounting fraud. These scandals weren't about internet business models, they were about old-fashioned fraud and greed. But they happened during the .com bust, and they added to the sense that something had been deeply wrong with the whole system, that the people in charge hadn't known what they were doing, or had been lying, or had been so caught up in the bubble that they'd abandoned basic principles of honesty and due diligence. The scandals led to new regulations, the Sarbanes-Oxley Act of 2002, designed to prevent similar failures. But regulations couldn't restore the billions of dollars that had been lost or the trust that had been broken. By late 2002, the worst was over in the sense that stocks had stopped falling. The Nasdaq would slowly begin to recover from its October bottom. But the damage was done. Thousands of companies had failed. Hundreds of thousands of jobs had been lost. Trillions of dollars in wealth had evaporated. An entire industry had been transformed from one of irrational exuberance to one of cautious skepticism. The word quote 20 went from being something you put in your company name to attract investors to being something you actively avoided because it suggested you were part of the bubble, part of the failure. The people who lived through this carried the scars. The employees who'd lost their jobs and their paper wealth learned not to trust stock options, not to believe in get-rich-quick promises, not to leave stable employment for exciting opportunities without carefully evaluating the risks. The investors who'd lost their savings learned about diversification, about not putting all their money in one sector, about the difference between a hot stock and a good investment. The entrepreneurs learned about business fundamentals, about the importance of a path to profitability, about unit economics and cash management and all the boring but essential parts of running a business. These were expensive lessons, paid for in lost money and lost time and lost opportunities. But they were lessons that would shape the next generation of internet companies. When the web came back, when startups started getting funded again, when the technology industry recovered, and it would recover, though that seemed hard to believe in 2002, the approaches would be different. The companies that succeeded in the 2000s and 2010s would be ones that learned from the dot-com bust, that understood what had gone wrong, that built on more solid foundations. But we're not there yet. Right now, in late 2002, the bubble has burst, the crash is complete, and Silicon Valley is picking up the pieces, trying to understand what happened and figure out what comes next. Let that moment settle, the aftermath, the quiet after the storm, the sobering realization of how much has been lost and how different the future looks now compared to the dreams of just 2 years earlier. In the quiet that followed the crash, in the empty office buildings and the shuttered warehouses and the homes where people who'd been paper millionaires now worried about making mortgage payments, there was time to think, time to ask the questions that should have been asked earlier, but that everyone had been too busy or too excited or too certain to consider. What had happened? How had so many smart people been so wrong? What had they missed? What should they have seen? The answers weren't simple because bubbles never are. There's never just one cause and never just one mistake. Instead, there are layers of errors and misjudgments and self-reinforcing cycles that build on each other until the whole structure becomes unstable. But let's try to understand it anyway, because understanding matters, even if it can't undo the damage, at the most basic level. The dot-com bubble was about confusing a genuine technological revolution with guaranteed profits. The internet was transformational. This part was true. It did change how people communicated, how they accessed information, how they shopped, how they worked. The skeptics who said the internet was a fad were wrong. The optimists who said it would change everything were right. But the leap from quote 21, quote 22, quote, was where the logic broke down. Transformation doesn't mean every company succeeds. It means the landscape changes, and some companies figure out how to thrive in the new landscape while others fail trying. The business fundamentals that had been ignored during the bubble turned out to matter after all. Revenue matters. Profit margins matter. Customer acquisition costs relative to customer lifetime value matter. Unit economics matter. These aren't old economy concepts that became obsolete with the internet. They're just economics. The laws of mathematics don't change because you're selling things online instead of in a store. If it costs you more to acquire and serve a customer than that customer pays you, you lose money. Do this at scale and you lose money faster. This seems obvious in retrospect, but during the bubble it was treated as if it were antiquated thinking, as if the rules had changed. The get big fast strategy made sense only for companies with genuine network effects or economies of scale. eBay benefited from network effects. The more buyers and sellers on the platform, the more valuable it became to everyone. Google, which was still young during the bubble but would emerge as dominant afterward, benefited from having more data and more users to improve its search algorithms. But an online pet food store didn't get meaningfully better from being twice as large. The cat food was the same. The service was the same. The only thing that changed with scale was that you lost money faster because the economics didn't work at any scale. First mover advantage, another concept used to justify reckless spending, turned out to be less powerful than people thought. Being first gave you a head start, yes, but it didn't guarantee victory. In many markets, the first mover was actually at a disadvantage. They had to educate the market, make mistakes that later entrants could learn from, build infrastructure before anyone knew what infrastructure would be needed. Often, the second or third mover, watching what the first mover did wrong, could succeed where the pioneer failed. Amazon wasn't the first online bookstore. Google wasn't the first search engine. Facebook wasn't the first social network. Being first mattered less than being good, being sustainable, having solid fundamentals. The role of easy money can't be overstated. During the bubble, venture capital was abundant and relatively undisciplined. VCs funded hundreds of companies that probably shouldn't have been funded, or that should have been funded at lower valuations with more strings attached. The availability of money enabled bad business models to persist longer than they would have if funding had been scarce. A company that was losing money on every transaction could keep operating as long as investors kept writing checks. When the funding stopped, these companies died quickly because there was nothing underneath, no sustainable business, just a mechanism for converting investor money into revenue while hemorrhaging cash. The IPO market enabled this too. Companies went public too early, with too little proven, to investors who didn't really understand what they were buying. The investment banks that took these companies public earned fees regardless of whether the company succeeded. They had incentive to bring as many companies public as possible. Especially when every IPO seemed to double on the first day of trading, the regulators who were supposed to ensure that only appropriate companies went public were either asleep or overwhelmed or captured by the industry they were supposed to regulate. The system failed at multiple levels. The media played a role in inflating the bubble by celebrating every success and mostly ignoring the warning signs. Magazines put young internet entrepreneurs on their covers, painting them as visionaries and geniuses. Television coverage was breathless and uncritical. The few voices of skepticism were often dismissed or mocked. This created an environment where questioning the bubble seemed like being against progress, against innovation, against the future. Nobody wants to be the person saying it can't be done when everyone around them is doing it. Nobody wants to be left out when everyone else is getting rich. The social pressure to participate, to believe, to invest was enormous. Individual psychology mattered too. The fear of missing out drove many people to make decisions they later regretted. When your neighbour is making money in internet stocks and you're not, you feel like a fool. When your colleagues are joining startups and getting rich on stock options while you're staying at your boring corporate job, you feel left behind. So you jump in, not because you've done careful analysis, but because everyone else is doing it and you don't want to miss out. This is herding behaviour, and it's a fundamental part of how bubbles form and inflate. People are social creatures who look to others for cues about what's safe and smart. When everyone around you is doing something, it feels safe to do it too, even if it's actually risky. The psychological shift from boom to bust was jarring. During the boom, everything seemed possible. People believed they were smarter than they were, luckier than they were, living in special times when normal rules didn't apply. During the bust, that confidence evaporated. People who had felt like masters of the universe suddenly felt foolish and naive. The same decisions that had seemed bold and visionary during the boom looked reckless and stupid during the bust. Nothing had fundamentally changed about the decisions themselves. What changed was the context and the outcomes. Silicon Valley after the bust was a humbler place. The office parks that had been full of startups with free food and game rooms and ping-pong tables were now either empty or occupied by more serious, more careful companies. The parties stopped. The talk about getting rich quick stopped. People who still worked in tech were more focused on building real businesses with real revenue and actual paths to profitability. The word profitable stopped being something you could defer thinking about until later and became something you needed to show, or at least credibly demonstrate you could achieve. The human cost of the bust was real and lasting. People lost jobs, savings, houses, marriages. The stress of going from seemingly wealthy to broke, of believing you'd succeeded only to discover you'd failed, of having to start over, this took a psychological toll that lasted years. Some people left the technology industry entirely, finding work in other sectors, deciding that the boom and bust cycle of tech was too volatile, too risky, too damaging to their well-being. Others stayed but changed how they approached their careers, being more cautious about which companies to join, negotiating for more cash and fewer stock options, building savings instead of spending on luxuries they couldn't really afford. For investors, especially ordinary people who'd put their retirement savings into internet stocks, the lessons were painful but clear. Diversification matters. Don't put all your money in one sector, no matter how promising it seems. Due diligence matters. Understand what you're investing in, not just the story, but the actual business fundamentals. Valuations matter. A great company can be a terrible investment if you pay too much for it. And perhaps most importantly, be skeptical when everyone agrees about something, because unanimous agreement often means we're in a bubble where dissenting voices have been silenced or ignored. The entrepreneurs who lived through the bust learned different lessons. Some learned that hype and marketing can't substitute for a real business model. Some learned the importance of capital efficiency, of building something sustainable rather than something that requires constant infusions of cash. Some learned about the value of slow, steady growth rather than explosive growth fueled by borrowed or invested money. And some learned that failing isn't the end of the world, that you can fail, pick yourself up, learn from your mistakes, and try again. Silicon Valley's culture of accepting failure as a learning opportunity, which existed before the bubble but became stronger afterward, helped many entrepreneurs recover and eventually succeed. The companies that survived the bust, that made it through from the bubble years to profitability and beyond, offer interesting case studies in what worked. Amazon survived by ruthlessly focusing on customer satisfaction and by having Jeff Bezos as CEO, someone who was willing to take the long view, to accept years of losses while building infrastructure and market share, and who had the credibility with investors to keep them patient during the darkest days. The company cut costs, sold bonds to raise cash, proved it could be profitable in certain categories even while investing heavily in growth in other areas. By 2003, Amazon was reliably profitable, and by 2004, it was clear the company would not only survive but thrive. eBay survived because its business model was fundamentally sound. Taking a percentage of transactions without having to hold inventory or ship products was a good business with reasonable margins. The company had challenges: fraud, competition, the need to keep innovating. But it was built on solid economic foundations. It cut costs during the bust, focused on its core business, and emerged stronger. Priceline barely survived. The company came within days of bankruptcy, had to restructure its debt, had to fundamentally rethink its business model. But it made it through, and the strategies developed during the crisis years, focusing on hotel bookings, expanding internationally, improving the technology platform, set the stage for the company to become quite successful in later years. But in 2002 and 2003, it was just trying to survive day by day. And then there was Google, which represented what the new generation of internet companies would look like. Google had been founded in September 1998, right in the middle of the bubble, but it stayed private during the boom years, avoiding the IPO mania. The founders, Larry Page and Sergey Brin, focused on building a great product, a search engine that was demonstrably better than the alternatives. They figured out a business model, advertising that was relevant and unobtrusive, sold through auctions that let the market set prices. By the time Google went public in August 2004, it was already profitable, already generating massive revenue, already proving that it was a real business built on solid foundations. Google's IPO was different from the 1999 IPO mania. The company was mature, profitable, growing rapidly from a sustainable base. The offering was structured to give the founders control and to attract long-term investors rather than flippers looking to make a quick buck. The stock price was set more conservatively, and while the stock did rise on the first day of trading, it wasn't the 100 or 200% gains that had characterized bubble-era IPOs. It was a more measured, more rational increase that reflected genuine value creation, rather than speculation and hype. Google represented the lessons learned from the dot-com bust. Focus on the product first, business model second. Build something people genuinely want and will use. Figure out how to make money from it in a sustainable way. Grow efficiently. Don't spend money just because you have it. The contrast between Google's approach and the approach of most bubble-era companies was stark. Both were internet companies, both aimed to change how people interacted with the web, but one was built to last while the others were built on hope and hype. The concept that emerged to describe the post-bust era was Web 2.0, Web 2.0. This phrase, coined by Tim O'Reilly and others around 2004, tried to distinguish the new wave of internet companies from the failed bubble companies. Web 2.0 companies supposedly learned from the mistakes of Web 1.0. They focused on user-generated content, on social features, on advertising models that actually worked, on services rather than products. Companies like Flickr and Delicious and later Facebook and Twitter and YouTube would be categorized as Web 2.0. Whether these companies were actually doing something fundamentally different or just doing the same things better and more carefully was debatable, but the label served a purpose. It let entrepreneurs and investors say, quote, 26, quote, and they had learned to some degree. The companies founded in the mid-2000s were generally more careful about spending, more focused on metrics and fundamentals, more realistic about timelines to profitability. Venture capitalists were more disciplined, doing more due diligence, investing at lower valuations, requiring more proof before writing checks. The IPO market remained relatively quiet through the mid-2000s, which meant companies had to build real businesses before they could go public. The market had been reset, and while it would eventually heat up again, markets always do, the reset brought a few years of more rational behaviour. What had the bubble built despite all the destruction? The infrastructure, for one thing. All those fibre optic cables that had been laid during the boom, connecting cities and countries with high bandwidth internet. Those remained and became the backbone of the modern internet. The data centres that had been built, many of them survived, operated by companies that bought the assets cheap after bankruptcies. The millions of people who had gotten internet access for the first time, trained by bubble-era companies to shop online and use web services, they remained. And they became the customer base for the next generation of internet businesses. The human capital remained too. Engineers and designers and product managers who'd learned their skills at bubble companies went on to work at successful companies or start new ones, bringing their experience and knowledge. Some of the best talent in technology came from bubble-era companies, people who'd learned what not to do by watching their employers fail. Failure teaches powerfully if you survive it and reflect on it. Perhaps most importantly, the bubble proved that people would use the internet for commerce, for communication, for entertainment, for work. The basic hypothesis that the internet would become central to daily life was validated. The specific execution by hundreds of bubble-era companies failed, but the underlying vision was correct. People did want to shop online. They did want to connect with friends digitally. They did want access to information at their fingertips. They did want online services that made their lives easier. The market was real. The opportunity was real. The bubble-era companies mostly failed to capture that opportunity profitably, but the opportunity remained for companies that could execute better. By 2004, the dust had settled. The Nasdaq had recovered somewhat from its October 2002 bottom, though it was still far below its peak. The surviving internet companies were growing again, but more carefully, more sustainably. New companies were being funded, but with more scrutiny and at more reasonable valuations. Silicon Valley was recovering, sadder but wiser. Ready to try again, but with fewer illusions about how easy it would be. The lessons of the bubble and the bust had been expensive, but they'd been learned. The next wave of internet companies would be built on those lessons, on the understanding that technology changes quickly but economics doesn't, that innovation matters, but so do fundamentals, that the future is digital but getting there requires patience, discipline, and respect for the basics of business that have always mattered and always will. Let that understanding settle, that sense of wisdom earned through failure, of clarity that comes only after illusions have been stripped away. The bubble was over, the lessons remained, and the internet story was far from finished. It was really just beginning. The remarkable thing about the dot-com bubble, when you look back from a distance, is not just how much was destroyed, but how much remained. How the wreckage of failed companies became the foundation for what came after. How the infrastructure built during the boom years, even though it was built for companies that failed, persisted and made possible the internet we know today. It's as if someone had built roads to towns that never got settled, and those roads remained, empty at first, but eventually carrying traffic to places the original builders never imagined. Consider the fibre optic cables. During the late 1990s, telecommunications companies spent hundreds of billions of dollars laying fibre optic cable across continents and under oceans. They were building infrastructure for an internet economy that they assumed would grow exponentially forever, that would need unlimited bandwidth to serve unlimited customers. Companies like WorldCom and Global Crossing and Level 3 Communications borrowed enormous sums to build these networks. Many of these companies went bankrupt when the bubble burst, when it turned out the demand they'd anticipated was years or decades away, not immediately at hand. But the cables remained. The fibre in the ground didn't disappear when the companies went bankrupt. It was bought by other companies, often for pennies on the dollar, and it became the backbone of the modern internet. All that excess capacity that seemed wasteful in 2000 and 2001 turned out to be exactly what was needed when YouTube launched in 2005, when Netflix started streaming video in 2007, when millions of people started watching high-definition video online. The companies that built the infrastructure failed, but the infrastructure they built enabled the successes that came after. The data centers built during the boom were similar. Massive buildings full of servers and networking equipment, built to house the computers of dot-com companies that thought they'd grow forever. When those companies failed, the data centers didn't disappear. They were repurposed, sold, leased to new tenants. Amazon, which had built its own substantial infrastructure during the bubble years, eventually turned that infrastructure into a business. Amazon Web Services launched in 2006, which let other companies rent computing power and storage rather than building their own data centers. This became one of Amazon's most profitable businesses, worth billions. Built on infrastructure that had originally been created to support Amazon's retail operations. The human capital that emerged from the bubble was perhaps even more valuable than the physical infrastructure. Thousands of engineers, designers, product managers, marketers had cut their teeth at dot-com companies. They'd learned how to build websites, how to scale systems, how to acquire customers online, how to analyze user behavior, and crucially, they'd learned what didn't work. They'd seen firsthand how companies could fail despite having smart people and good technology, if the business model was flawed. This knowledge, paid for with billions of dollars of investor money and years of effort, became the intellectual capital that informed the next generation of internet companies. Some of these people started new companies, applying the lessons they'd learned. Others joined existing companies, bringing their expertise. Still others became investors or advisors, helping the next generation avoid the mistakes of the previous one. Silicon Valley's culture of treating failure as education, of valuing people who'd failed at previous startups because they'd learned from the experience, meant that the knowledge gained during the bubble wasn't lost. It was passed down, incorporated into the wisdom of the technology industry. The most important legacy might be the simple fact that hundreds of millions of people had gotten online during the bubble years and had learned to use internet services. They'd bought books from Amazon, bid on auctions at eBay, searched on Google, checked email, browsed websites. The dot-com companies had spent billions on advertising and customer acquisition, training users in how to interact with the internet. When those companies failed, the users remained. They were now comfortable with e-commerce, with clicking on links, with entering credit card information online, with the basic vocabulary and mechanics of the internet. This installed base of experienced users was an asset for whatever companies came next. The social media boom that began in the mid-2000s built directly on the foundations laid during the dot-com era. Friendster launched in 2002, MySpace in 2003, Facebook in 2004. These companies understood something the bubble-era companies often hadn't. You need to achieve product-market fit before you worry about monetization. You need to build something people genuinely love, something that creates real value, and then figure out how to make money from it. Don't start with the business model, start with the product. Facebook, which would become the dominant social network, learned from the mistakes of predecessors. When it launched, it was exclusive, first just for Harvard students, then expanding gradually to other colleges, then to high schools, then eventually to everyone. This controlled growth helped maintain quality and gave the company time to build infrastructure before serving hundreds of millions of users. And Facebook didn't try to monetize immediately. It waited until it had massive scale, until it deeply understood its users, before rolling out advertising. When advertising came, it was targeted and effective in ways that banner ads from the bubble era never were. YouTube, which launched in 2005, created enormous value by letting users upload and share videos. The company was acquired by Google in 2006 for $1.65 billion, a price that seemed high at the time but that proved to be a bargain. YouTube wasn't profitable initially. The bandwidth costs of serving video to millions of users were enormous. But Google had the resources and patience to invest in making it work. By the 2010s, YouTube was generating billions in advertising revenue, proving that video advertising could work if the platform was good enough and the audience large enough. Twitter, which launched in 2006, offered a simple service, short messages that anyone could post and anyone could read. It seemed almost too simple at first, but it turned out that simplicity was powerful. Twitter became a platform for news, for conversation, for celebrity culture, for political discourse. Monetizing it effectively took years, and the company went through multiple strategies before finding ones that worked. But the user base was real. The engagement was real. And eventually the business model caught up. These companies, Facebook, YouTube, Twitter, represented what people called Web 2.0. They were user-generated content platforms, places where the users created the value rather than the company creating all the content. They benefited from network effects in genuine ways. Twitter was more valuable the more people used it, because there were more people to follow and talk to. Facebook was more valuable the more friends joined, because that's where you could connect with them. These network effects created real moats, real competitive advantages that made the companies hard to displace once they achieved scale. But the Web 2.0 companies also learned from the bubble. They were generally more careful about spending. They proved their models in one market before expanding to others. They measured what mattered, not just page views but engagement, not just registered users but active users, not just growth but growth that was sustainable and based on genuine value creation. Venture capitalists were more disciplined too, asking harder questions, investing at lower valuations, requiring more milestones before subsequent funding rounds. The mobile revolution, which began with the iPhone in 2007, created another wave of opportunities and another test of the lessons from the bubble. Suddenly everyone had a computer in their pocket, connected to the internet at all times. This opened up new use cases, new business models, new ways of interacting with digital services. Companies that understood mobile early, Instagram, WhatsApp, Uber, Snapchat, could grow enormously quickly because the distribution was built in. You didn't need to convince people to sit down at a computer. They already had the device with them everywhere they went. Some of these mobile-first companies made the bubble-era mistake of prioritizing growth over profitability. Uber, founded in 2009, achieved enormous scale and billions in revenue, but lost billions of dollars trying to dominate ride-sharing globally. The strategy was explicitly to get big fast, subsidize rides to attract users, drive competitors out of business, then eventually raise prices and become profitable. Whether this strategy would work remained unclear even a decade after the company's founding. It felt familiar, this willingness to lose money at scale in pursuit of dominance. But mobile markets genuinely did have winner-take-most dynamics in some cases, which made the strategy at least more plausible than it had been for online pet food stores. The 2008 financial crisis, while not directly related to the dot-com bubble, offered interesting parallels. Once again, Sophisticated investors and institutions had convinced themselves that risk had been eliminated, that new financial instruments had changed the rules, that housing prices would never fall nationally. Once again, the warning signs were ignored or dismissed. Once again, when reality reasserted itself, the losses were enormous and widespread. The technology companies that had survived the dot-com bust generally survived the 2008 crisis too, though their stock prices fell and they had to cut costs. But the structural weaknesses in the financial system, excessive leverage, complex instruments nobody fully understood, perverse incentives that encouraged risk-taking, these paralleled the structural weaknesses that had caused the dot-com bubble. Did we learn the lessons from the dot-com bubble? In some ways, yes. In some ways, no. The internet companies founded in the 2000s and 2010s were generally more focused on fundamentals than bubble-era companies had been. But speculative excess never completely disappears. It just moves to new areas, takes new forms. The cryptocurrency boom of the 2010s had distinct echoes of the dot-com bubble. Initial coin offerings, where startups raised money by selling digital tokens, resembled the sketchy IPOs of the bubble era. Companies with minimal actual business or technology raised millions by promising blockchain-based solutions to problems that might not exist. Investors who'd missed out on early Bitcoin or Ethereum returns poured money into newer cryptocurrencies, hoping to get rich quick, just as investors in the 90s had poured money into internet stocks. Some aspects of cryptocurrency represented genuine innovation. Blockchain technology had real potential applications. And Bitcoin proved that decentralized digital currency could work, at least in some contexts. But much of the crypto boom was speculation and scams and projects that made no sense, but that raised money anyway because crypto was hot and investors were afraid of missing out. The parallels to the dot-com bubble were obvious to anyone who'd lived through both. Even the language was similar. This time is different. The old rules don't apply. You just don't understand the technology. Modern technology valuations in the 2010s raised questions too. Private companies achieving billion-dollar valuations, unicorns in the terminology that emerged, before they were profitable or sometimes before they had significant revenue. Wasn't this familiar? Weren't we valuing growth and potential rather than actual results, just as we had during the bubble? The defenders argued that these companies were fundamentally different, that they had real users and real engagement and network effects that would eventually translate to enormous profits. The skeptics argued that many of them had unsustainable business models, that they were burning through investor cash just as bubble-era companies had, that we were in another bubble that would eventually pop. The truth was probably somewhere in between. Some unicorns were genuine businesses that would become the Amazons and Googles of the next decade. Others would fail spectacularly, just as Pets.com and Webvan had failed. Distinguishing between them in real time was difficult, just as it had been during the dot-com era. The safest prediction was that some would succeed and most would fail, because that's how capitalism works. That's how innovation works. Failure is not just possible but likely, and the successful companies earn such enormous returns partly because they're survivors of a brutal selection process. What was genuinely transformative about the internet? As distinct from the bubble mania, the ability to connect people across distances instantly and cheaply. This was real. The ability to access information from anywhere at any time. Real. The ability to match buyers and sellers more efficiently. Real. The ability to distribute content without physical distribution costs. Real. The ability to coordinate collective action among people who'd never met. Real. These capabilities were genuinely new, genuinely valuable, genuinely transformative. But the transformation took longer than bubble-era enthusiasts expected. E-commerce in 2020 represented only about 15% of total retail sales in the United States. Significant but not dominant. Physical stores still mattered. Most people still worked in traditional industries, not internet companies. The revolution was real but gradual, playing out over decades rather than years, requiring sustained effort and investment and learning rather than instant transformation. The people who'd held onto Amazon stock through the bust, who'd bought when the price was $5 or $6 per share in 2002, who'd had the conviction or stubbornness to hold through years of volatility, they were eventually vindicated. By 2020, Amazon was worth over $1.5 trillion. $1,000 invested at the bottom would have been worth hundreds of thousands of dollars 2 decades later. But holding through that period, through all the doubt and fear and uncertainty, through times when it seemed like the company might fail, that took either extraordinary conviction or extraordinary luck or both. eBay stockholders who held through the bust saw their investment recover and grow, though not as dramatically as Amazon. Google stockholders who got in at the IPO in 2004 and held saw remarkable returns. Facebook investors who bought in early did even better. The lesson seemed to be that if you could identify the genuine winners and hold them through volatility, the returns could be extraordinary. But that quote 31 was doing a lot of work. How did you know which companies would be winners? How did you maintain conviction during the dark times? How did you distinguish between a temporary setback and a permanent impairment? These questions were easier to answer in hindsight than in the moment. By the year 2020, the internet was so woven into daily life that it was hard to remember what life had been like before it. Young people who'd grown up with smartphones and social media and streaming video couldn't imagine the pre-internet world their parents had inhabited. The transformation that bubble-era entrepreneurs had predicted had largely happened, just not on the timeline they'd anticipated, and not in exactly the ways they'd imagined. The internet had changed commerce, media, communication, work, entertainment, politics, relationships. It had created enormous value and enormous new problems. It had made some people fabulously wealthy and destroyed others. It had been both as revolutionary as promised and as mundane as any mature technology eventually becomes. The dot-com bubble stood as a historical episode that contained lessons, but not simple ones. It showed that genuine transformation can coexist with speculative excess. That being right about the big picture doesn't mean being right about specific investments. That markets can be rational in the long run, but wildly irrational in the short run. That human psychology, greed and fear and herd behavior matters as much as technology and business models. That fortunes can be made and lost with remarkable speed. That some portion of what seems insane during a bubble turns out to have been prescient, while most of it was just insane. The survivors carried the memories, the lessons, the scars. They knew what it felt like to believe you were rich only to discover you were broke. They knew the difference between paper wealth and real wealth. They knew that markets could fall as well as rise, that confidence could evaporate overnight, that you should never bet more than you could afford to lose. These weren't abstract lessons from textbooks. They were lived experiences, burned into memory by the emotional intensity of having been through it. And those lessons, passed down through stories and warnings, and the cultural memory of Silicon Valley and the broader technology industry, became part of the inheritance of the next generation. Not always heeded, because each generation thinks they're smarter than the last, thinks their situation is different. But they're available for those wise enough to learn from others' mistakes rather than insisting on making their own. The bubble was over, long over, but its echoes would reverberate through decades, shaping how people thought about technology and investment and risk and the future. A reminder that human nature doesn't change even when technology does, that we're always capable of believing too strongly in our ability to predict and control the future, and that humility, caution, and respect for history might not be exciting, but they might save you from catastrophic mistakes. Let that wisdom settle, earned not through study but through loss, not through reading but through living. The past speaks if we listen. The statistics and the business stories help us understand the bubble, but they don't quite capture what it felt like to live through it. The experience of being there, of making decisions in real time with incomplete information, of hoping and fearing and wondering if you were making the right choices, that lived reality is different from the cleaned-up narrative we tell afterward. So let's slow down and think about the individual people, the human beings whose lives were changed by those years, whose stories are less famous than Pets.com or Amazon, but no less real. Consider someone we'll call Sarah, a composite of real experiences but not any single person. Sarah was an administrative assistant at a technology company in 1998. She answered phones, scheduled meetings, ordered supplies, did the mundane work that keeps offices running. Her salary was $35,000 a year, enough to live on but not enough to build wealth. She'd never invested in stocks before. That was something wealthy people did, not administrative assistants. But her company was growing, and as part of her compensation package, she received stock options. Not many. Maybe 5,000 shares at an exercise price of $2 per share. Nobody explained to her exactly what this meant or how it worked. She knew that if the company went public and the stock went up, the options might be worth something. That was about the extent of her understanding. She put the option grant letter in a folder and went back to answering phones. The company did go public in April 1999. On the first day of trading, the stock closed at $38 per share. Sarah, who had barely thought about her options, suddenly realized that on paper, they were worth $180,000. She could exercise the options for $10,000, 5,000 shares at $2 each, and immediately sell the shares for $190,000. After taxes, she'd have over $100,000. More money than she'd make in 3 years of working. More money than she'd ever imagined having. But she couldn't exercise the options yet because there was a vesting schedule. They became exercisable gradually over 4 years. And she couldn't sell them immediately even after exercising because of lockup restrictions. So the wealth was theoretical, numbers on a statement, not actual money she could touch. She watched the stock price, $40 per share, 50, 60. By December 1999, the stock was at $85 per share. Her options were now worth $415,000 on paper. She could barely breathe when she thought about it. $415,000. She could buy a house. She could retire early. She could do anything. Friends and family started treating her differently when they heard about her stock options. Suddenly she was the one everyone asked for investment advice, as if answering phones at a tech company made her an expert on the stock market. Her boyfriend started talking about getting married, about buying a house together, about all the things they could do with that money when the options vested and the lockup expired. She felt the weight of expectations, the pressure of wealth she didn't actually have yet, but that everyone assumed she would have soon. The first options vested in April 2000, a year after the IPO. By then, the stock had fallen from its peak, but was still at $62 per share. Sarah exercised those options, 1/4 of the total, 1,250 shares, paying $2,500 to exercise them. She sold the shares immediately, not wanting to risk holding them. After taxes, she netted about $50,000. Real money finally. She paid off her credit card debt, bought a reliable used car, put the rest in savings. It felt good, felt real, felt like validation that all the stress and uncertainty had been worth it. But the stock kept falling. By summer 2000, it was at $30. By fall, $20. By the end of the year, $12. Her remaining options, 3,750 shares at a $2 exercise price, were worth $37,500 instead of the hundreds of thousands they'd been worth at the peak. She told herself it was okay. She'd already gotten $50,000 out. That was more than she'd expected. But she couldn't help doing the math on what she'd lost by not selling at the peak. If she'd been able to sell everything at $85 per share, she'd have $415,000. Instead, she had $50,000, and options that might never be worth much again. The company laid off half its staff in March 2001. Sarah kept her job, but she watched colleagues she'd worked with for years get walked out of the building with their belongings in boxes. The office felt empty, haunted. The enthusiasm and optimism of the boom years were gone, replaced by a grim determination to survive. The stock fell to $3 per share. Her remaining options were barely worth exercising. She'd pay $2 per share to exercise them and sell for $3, netting only $1 per share before taxes. After 3 years of volatility and stress, after watching her paper wealth appear and disappear, she ended up with about $50,000 from her options. Life-changing money, yes, but a fraction of what it had almost been. Sarah's story was repeated thousands of times with different numbers and different details, but the same emotional arc: hope, excitement, paper wealth, the pressure of expectations, the fall, the realization that paper wealth isn't real wealth until you sell. Most people, like Sarah, ended up with something. More than they started with, but far less than they'd almost had. The psychological impact of watching wealth appear and disappear, of feeling rich and then not rich, of having to adjust expectations and dreams, that was harder than the financial impact. Or consider Michael, another composite, a software engineer fresh out of college in 1999. He had multiple job offers from different companies. A large, established company offered him $75,000 per year plus benefits and a small amount of stock. A startup offered him $60,000 plus stock options for 1% of the company. His parents urged him to take the established company: security, stability, benefits. But all his friends were joining startups, talking about stock options and IPOs and getting rich. Michael took the startup offer, turning down an extra $15,000 per year because he believed in the vision, believed in the potential, believed the options would be worth millions someday. The startup burned through its funding by mid-2000 without achieving the milestones needed to raise more money. Michael's 1% of the company ended up being 1% of nothing. He'd worked insane hours, 60, 70-hour weeks, for less pay than he could have gotten elsewhere, all for options that became worthless. He spent a year unemployed or underemployed after the startup failed, competing with thousands of other engineers for a limited number of positions. By the time he found steady work again, he'd burned through his savings and had to move back in with his parents at age 24. But Michael learned. He learned to evaluate companies more carefully, to ask hard questions about business models and cash runway, to negotiate for more cash and fewer options, to not believe the hype. 10 years later, when he joined another startup that was actually well run and had a sustainable business model, his skepticism and caution served him well. He negotiated better, understood the risks, didn't count on the options until they were actually worth something. And when that company was acquired and his options did pay out, he sold immediately and diversified, having learned that paper wealth disappears. The first startup failed, but the education he got from that failure had value that helped him make better decisions later. The marriages and relationships affected by the bubble had their own stories. Couples who bought houses they couldn't afford based on expected stock option wealth, who then had to sell at losses or go through foreclosure when the options became worthless, and one or both partners lost their jobs. The stress of financial pressure breaking relationships that might have survived otherwise. Or alternatively, couples who'd been through the worst together, who'd lost everything and rebuilt together, who came out stronger because they'd weathered the storm as a team. Crisis reveals character, tests relationships, forces people to show who they really are when things are hard. Some people rose to the occasion, others didn't. There were also families where one member had gotten rich, actually rich with money they'd sold and kept, while other members struggled. The cousin who joined Amazon in 1996 and held through the bust, who was now genuinely wealthy, attending family gatherings where other people were still working regular jobs and trying to pay bills. The awkwardness of that wealth disparity, the mixture of pride and jealousy and resentment that families rarely talked about openly. Money changed relationships, even within families, especially when the wealth came from luck or timing as much as from skill or effort. The investors who'd put their retirement savings into internet stocks lived with the consequences for years. A man who'd had $300,000 in his 401k in March 2000, who watched it shrink to $100,000 by October 2002. That money was supposed to fund his retirement, and now he had to work another decade to rebuild what he'd lost. He couldn't blame anyone but himself. Nobody forced him to put everything in tech stocks. Nobody told him not to diversify. But the regret, the anger at himself, the sense of having been foolish, those feelings didn't fade quickly. Some of these investors never fully recovered financially. They were in their 50s or 60s when the bubble burst, close to retirement age, and they didn't have time to rebuild. They had to adjust their expectations, accept a lower standard of living in retirement, maybe keep working longer than they'd planned. The loss wasn't just financial, it was loss of dreams, loss of the future they'd imagined. And for those who'd encouraged friends and family to invest in tech stocks, who'd shared their enthusiasm and optimism, there was guilt too. They'd not just lost their own money, but had influenced others to lose theirs. Then there were the few timed it right, who sold near the peak and kept the money. They existed, though they were rare. Someone who'd bought Cisco or Oracle or Intel in the mid-90s and sold in late 1999 or early 2000, who'd turned tens of thousands into hundreds of thousands or more. These people faced different challenges, mainly the challenge of watching the market keep going up after they sold, the fear that they'd sold too early, the temptation to get back in. And then when the market crashed, they felt vindicated but also isolated. Their friends who'd lost money didn't always want to hear about how smart they'd been to sell. Success can be lonely, especially when it comes at the expense of being excluded from shared suffering. The community impact was real too. Silicon Valley went from feeling like the center of the universe, the place where the future was being built, to feeling like a place where a lot of people had made mistakes together. The office parks with Felice signs, the restaurants that had been full of .com employees celebrating funding rounds that were now struggling to stay open, the culture of hustle and optimism replaced by something more cautious and subdued. Communities that had bonded over shared enthusiasm now had to figure out how to bond over shared failure, shared loss, shared rebuilding. Some people left Silicon Valley entirely during the bust, moving to cheaper cities, finding work in other industries, deciding that the boom and bust cycle of technology wasn't worth it. They wanted stability, wanted careers they could predict, wanted to not wake up every morning wondering if today would be the day they got laid off. The brain drain from Silicon Valley in 2001 and 2002 was real, though it would reverse as the industry recovered. The lasting psychological impact showed up in different ways for different people. Some became permanently cautious, never again willing to take risks with money or career, always keeping a substantial emergency fund, always assuming the worst could happen. Others went the opposite direction, deciding that since you can't predict or control outcomes, you might as well take big swings because the potential upside is worth the risk. Most people ended up somewhere in between, more cautious than they'd been during the bubble but not paralyzed by fear. The generation that lived through the .com bubble as young adults carried those lessons into their 30s and 40s and 50s. They taught their children to be skeptical of get-rich-quick schemes, to diversify investments, to not believe everything they heard about hot opportunities. Some of these children listened, others made their own versions of the same mistakes with cryptocurrency or meme stocks, or whatever the next mania was. Human nature is constant even as the specific opportunities and technologies change. What did it feel like to live through it? In the boom years, it felt exciting, intoxicating. Like being part of something historic, like the future was arriving ahead of schedule and you had a front row seat. The parties, the optimism, the sense of possibility. These were real, and they were genuinely enjoyable while they lasted. People who lived through that time remember the excitement even as they remember the crash. Both were real. Both were part of the experience. During the crash, it felt like betrayal, like discovering that something you'd believed in was a lie. The confusion of not knowing what to do, whether to hold or sell, whether to stay at your job or look for something more stable. The fear of losing everything, of having made catastrophic mistakes that would affect your life for years. The embarrassment of having believed, of having been one of those people who thought they were smart but who turned out to be as foolish as everyone else. The isolation of suffering losses you couldn't talk about, because everyone else was suffering too and nobody wanted to hear about it. And then the slow recovery, the rebuilding, the process of accepting what had happened and figuring out how to move forward. This part wasn't dramatic or exciting, just the daily work of paying bills and looking for jobs and saving money and trying to rebuild confidence and security. The realization that life continues even after disaster, that you can survive things you thought would destroy you, that there's a kind of strength that comes only from having been through difficult times and come out the other side. The people who lived through the .com bubble weren't heroes or villains, weren't geniuses or fools. They were just people, making decisions with the information they had, doing their best to build lives and careers and futures in uncertain times. Some got lucky. Some got unlucky. Most were somewhere in between. They fell in love and had children and got divorced and changed careers and moved to new cities and all the ordinary things people do. But with the bubble as a formative experience that shaped how they thought about risk and money and work and the future. Their stories matter not because they're unique. People have been getting caught up in financial bubbles for centuries, but because they're human. Because understanding the individual experience helps us understand the collective madness, helps us see how reasonable people can believe unreasonable things, how optimism can turn to delusion, how fear can be as powerful as greed. The statistics tell us what happened. The individual stories tell us what it meant, what it felt like, what lessons were learned at the cost of years and money and peace of mind. These stories are worth remembering, worth honouring, worth learning from, even as, especially as, we recognise that we're all capable of making similar mistakes in different contexts. Let these stories settle in your mind, these individual lives touched by history, these particular joys and sorrows that collectively made up something larger than any individual could have understood at the time. And so we've travelled together through the .com bubble, from the first moments of wonder when the internet felt like magic, through the years of wild optimism and impossible dreams, through the crash and the quiet that followed. We've walked with people who believed they were building the future, who were right about that in ways they couldn't imagine and wrong in ways that cost them dearly. We've witnessed how easily hope becomes excess, how quickly confidence becomes delusion, and how the difference between vision and fantasy is only clear when looking backward. If you've enjoyed this gentle drift through one of history's most fascinating financial moments, a like and subscribe helps others find these calm explorations, and to those already here, thank you for this time together. Wherever you are now, whatever brought you here tonight, I hope you found some peace in this story. The bubble happened long ago. The people who suffered have mostly healed. The money that was lost is just numbers now, just history. What remains is the reminder that we're all capable of believing too much and fearing too late, of following crowds and learning through loss. But we're also capable of recovering, rebuilding, trying again with wisdom earned through failure. Let your breathing slow now. Let the story fade into background. The screen can dim, your thoughts can quiet. You've been here long enough. There's nothing more you need to know tonight. Just rest, just drift. The future will take care of itself, as it always does. Good night.